earnings breath revision somewhat positive, and now that's kind of reversed.
So, do you guys, how much earnings risk do you guys see in this market?
I think if we're talking about a recessionary forecast or a lower growth type scenario, that there is probably some downside risk to earnings for next year.
All right, Kelly Kowalski, thanks so much for joining us. Kelly Kowalski is a portfolio manager at Mass Mutual Insurance Company, so investing primarily in the longer-term fixed income as to match those assets and liabilities. Looking at the market here, we still have some gains, kind of off the highs, no question. The S&P 500 is up about 0.3%. The Dow's pretty much unchanged on the day. Had been, much higher earlier in the day. Nasdaq's up about 0.5%. Yields coming in pretty much across the board. Let's look at the 10-year Treasury. That's in 11 basis points, 4.81%. So a pretty big move there in the 10-year. Same for the 30-year in 11 basis points. Now below 5% at 4.97%. WTI crude oil, it's up just slightly, just about $81.50 per barrel for WTI crude oil. We're going to have more coming up. This is Bloomberg. Got some company news right now with Lisa Mateo.
Estee Lauder is falling to its lowest level since 2017 after the beauty brand lowered its full-year outlook. Bloomberg's Isabel Lee says it's due to three things.
First, it's the pressures in Asia travel business. Second, it's a slower recovery in China. As we all know, we didn't see the pandemic boom that we were hoping, especially in the beauty sector. And lastly is the disruption in the Middle East and, of course, in other parts of Israel. So diving into earnings, Estee Lauder expects net sales in a range of a decrease of 2% to an increase of 1% year over year, and earnings of $2.08 to 2.35 cents a share.
Shares right now, they're down about 16.5%. The first major U.S. cruise operator has lowered its guidance this season. Norwegian Cruise cut its adjusted earnings per share forecast for the full year. Bloomberg's Katie Greifeld says outside of that, the quarter was actually pretty good.
The company beat on earnings, sales were in line with estimates, and the company also said that demand for trips to Maui is rebounding following the fallout from wildfires in that region. And just for some context, about 6% of its capacity typically stops in Maui in the fourth quarter, so that's good news.
But not so much good news for shares. Right now, they're down more than 2.5%. And Charles Schwab has laid off about 5 to 6% of its nearly 36,000 workers. Dow Jones reports that comes down to as much as 2,154 employees. Now, the cutbacks, they're part of an effort to save $500 million in the second half of the year. The company is looking to contain costs as it integrates its acquisition of TD Ameritrade. Now, Schwab is also making changes to its real estate footprint and streamlining its operational model. Those are the company's stories we're following. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Brokers studio. Looking at these markets, the S&P's up about 1/3%. The Nasdaq's up about 0.6%. Yields coming in, 10-year Treasury off about 11 basis points, 4.81%. WTI crude oil just up about 0.5% here, $81.50. Bitcoin off about 0.5% here, still around 34,400. It's had a nice little run here over the last week or so. It is Fed Day, 2 p.m. Wall Street time. We will bring you full coverage starting at 1:30 p.m. with the surveillance team. Right now, let's head down to Washington, D.C. We get world and national news with Nancy Lyons.
Thanks, Paul. Tensions are building in the Middle East, with Israel continuing to pound Gaza. For a second time in 24 hours, a refugee camp in northern Gaza was hit. The earlier attack killed and wounded hundreds. Israel says Hamas was using that camp as a training center. Jordan, in a sign of protest about the war, is recalling its ambassador to Israel. On a positive note, the first U.S. citizens are leaving Gaza. NBC News is reporting fewer than 10 Americans were traveling today through the Rafah border crossing with Egypt. More are expected to leave tomorrow. They're among the first group of foreigners allowed to leave. Vice President Kamala Harris is in London attending a conference on artificial intelligence and told those gathered today that it is important to lay the groundwork for the future of AI. She says the U.S. is creating the AI Safety Institute.
30 countries have joined our commitment to the responsible use of military AI, and I call on more nations to join.
Harris says AI could have the power to fight the climate crisis, make scientific breakthroughs, and explore the universe. Well, with Thanksgiving just 3 weeks away, some new details are coming in about what your turkey dinner might cost. Dr. Michael Swanson is the chief agriculture economist with Wells Fargo Agri-Food Institute.
There's some good news in that the turkey prices are falling. That's the main thing that we celebrate. Down about 13%. We put more birds in the barn. Other things are more expensive. Food inflation is still up about 2.5% from a year ago in September. So we expect some of the other things that you're putting on the table to be a little bit more expensive.
Swanson tells ABC that one item that's seen a spike in cost is canned cranberries. They're up a whopping 60%. Legendary entertainer Cher will be part of the 97th Macy's Thanksgiving Day Parade this year. She'll be performing a new holiday hit for the show. 7 new balloons will make their debut, including the Pillsbury Doughboy and Beagle Scout Snoopy. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. Now back to you, Paul and Matt.
All right, Nancy, thank you so much. We appreciate that. Well, for New York basketball fans, St. John's basketball is back. And for Rick Pitino, the road to revival at St. John's runs through Wall Street. The 71-year-old coach back in the Big East in an era when athletes are paid and have endorsement deals. He recently tapped a former Goldman Sachs executive to teach his players about managing their money. He's also been networking with the university's alumni in finance, and on Tuesday, he brought his team to New York Stock Exchange to ring the opening bell. For the Long Island-raised Pitino, it was a return to 11 Wall Street, which he previously visited with the Kentucky Wildcats after they won the 1996 national championship. These days, he's trying to restore St. John's to relevancy, especially in New York and at Madison Square Garden. St. John's was this legendary program that I grew up with in the 60s, the 70s, the 80s, and it's fallen on hard times, Pitino said in an interview. So we've got to bring it back, and it definitely can come back. Pitino has said this will be his last job. He came to St. John's, located in Queens, New York, after a stint at Iona College, where he returned to college basketball after coaching in Greece following his ouster from the University of Louisville after a bribery scandal. Pitino coached at Providence College back in the mid-'80s during a heyday for St. John's. The team made the Final Four, along with Georgetown and Villanova in 1985. But college basketball is a lot different these days. St. John's has struggled to compete consistently with top teams in recent years, and now so-called NIL money, payments for name, image, or likeness, is flowing to players. Looking at these markets right here as we finish out here this hour, the S&P 500 up about 0.3%. The Dow pretty much flattish, up about 0.1. The Nasdaq up 0.6%. Yield space yields coming in today ahead of the Fed meeting. 10-year Treasury off 11 basis points. So we will certainly follow that up. Coming up, Sound On with Joe Matthew, Washington, D.C. That starts right now.
Now, from our nation's capital, this is Bloomberg Sound On.
Two major stories that we're following here developing before our eyes.
What does it say about Trump's influence on the Republican Party?
What can the Biden administration do on its own to support Israel?
Bloomberg Sound On. Politics, policy, and perspective from D.C.'s top names.
The Republican caucus is at war with itself. Members of Congress would have a press conference every day if somebody would cover that.
There is bipartisan support for Israel.
This is one of the big ones we only see once every decade or 2 decades in the Middle East.
Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
The White House threatens to veto the Republican Israeli aid bill, as the CBO now says that bill will add to the nation's deficit. Welcome to the fastest show in politics, as we get a first look at the fine print in the speaker's plan on Israel, even as the president takes his own approach, including money for Ukraine and for the border. We'll be joined ahead by Bill Hoagland at the Bipartisan Policy Center with analysis from our signature panel. They're with us on this Fed Day. Rick Davis and Jeannie Shanzano weighing in as well on the latest from Washington and Israel. So let's start, as always, with a look at Wall Street. On an abbreviated session of Sound On, we begin with trading in New York and Denise Pellegrini. Hi, Denise.
Hi. Well, we are seeing... Hi there, Joe. Well, we are seeing some volatility, and it is 101 on Wall Street. We check the markets for you, of course, all day long here at Bloomberg. The stocks are higher, but not as higher as they might be. Concern about a stronger than expected jobs market, maybe a bit of a mood killer on this Fed Day, to say the least. Ann Milletti, head of active equity at Allspring Global Investments, is warning all the volatility and all the uncertainty means you really better stay diversified right now.
You want to stay diversified in this kind of environment, across sectors, across countries, across asset classes. But certainly, I definitely would lean, and of course I have a bias toward active management here, because you don't want to own the whole index.
And Milletti speaking there on our Bloomberg Surveillance podcast, which of course you can download wherever you get your podcast. And as we mentioned here on Sound On, stocks are higher. We'll have special Fed coverage coming up. Right now, the Dow is up just fractionally, up 20 points. The S&P 500 up 0.3%. Call it better by 13 points now. And the NASDAQ up by 0.6%, 71 points higher. The yield on the 10-year right now creeping a little bit higher from the low earlier in the session. 4.82% right now. COMEX gold, it's been lower all day, down about 0.2% at $19.78 an ounce. Crude oil right now, it is higher though, almost 1% higher. Crude right now sitting at $81.79 a barrel. Apollo Global Management shares, they're jumping almost 8%. That's the most in years, as investors look past a private equity deal slowdown and sheer momentum in the firm's massive credit business. On the other hand, we have Estee Lauder. It could really use a makeover. Shares are plummeting. They're down just about 18% right now. The beauty giant slashing its full-year outlook, Joe, on troubles in China and in the Middle East. And that is a Bloomberg Business Flash.
All right, Denise, thank you. And welcome to the Wednesday edition of Bloomberg Sound On. I'm Joe Matthew in Washington, where, of course, it's going to be all about the Fed, certainly here on Bloomberg, starting in about a half hour's time, when we'll bring you our special coverage of the Fed meeting, the announcement, and the news conference. But we have breaking news on Israel that I want to start with today, and I'm glad you're with us here on the radio, on the satellite, and on YouTube. You can always find us on YouTube by searching Bloomberg Global News. The cameras are lit. With the headline on the terminal, Biden says some Americans will depart Gaza today. We're just hearing this now from the White House, as the president says American citizens will exit Gaza today, and the U.S. expects more departures tomorrow and over the coming days. He also said safe passage has been secured for wounded Palestinians and for foreign nationals to exit Gaza. And this is the type of headline that some of his critics in his own Democratic Party have been looking to see, with much more news coming out of Israel and Washington here. The Speaker of the House, Mike Johnson, is having lunch today with the Senate Republican Conference. Interesting, as we turn to the matter of funding, and this is something we're going to talk about in a moment with Bill Hoagland. We brought this to you yesterday. The Speaker of the House wants to split Israel funding from the rest of the supplemental package that the president has put forward. And if you listen to this show, you could probably tell us by now yourself that was going to include Ukraine, the border, and Taiwan. Not so, says the speaker, who's going to bring that bill to the floor tomorrow, it looks like, and it is also expected to fail. So lawmakers are weighing in now. Republicans say this is a way of keeping the government from spending too much money. Then we heard from the CBO when we learned it's actually going to add to the deficit. And Senator Ben Cardin of Maryland, who's now chair of the Senate Foreign Relations Committee, says GOP is playing games with the money.
We need to keep this together because it represents the priorities that need to be done now. There are supplemental appropriations, which were not planned for in the normal appropriation process. There's no need for offsets, and we got to get this done without the political partisanship we see in the House.
Now, that's the chair. The Republican senator from Wyoming, John Barrasso, also on that committee, says, no, this is the way it should be done, and more specifically, pay for it by defunding the IRS.
I support defunding the IRS, taking that money out of that as a source of payment for the money to Israel. I want to make sure Israel has what they need to fight the war they need to fight.
So there you have it from both sides of the aisle. According to the Treasury Department, if that matters to you, those thousands of IRS employees will not be targeting small businesses and regular Americans. In fact, we heard from the IRS commissioner yesterday, said these offsets would end up costing $90 billion, in fact, because of less scrutiny on tax evasion at the highest levels of wealth. So much for armed agents knocking down your door. This is where we start with Bill Hoagland. Senior Vice President of the Bipartisan Policy Center, spent many years working on Capitol Hill, knows how the sausage is made, and might be helpful here with a reality check. Bill, two questions. Your thought, number one, on just putting Israel funding alone on the floor, knowing that it likely doesn't have support, but two, paying for it with IRS funding, calling it an offset when it's actually going to cost more. Maybe you can help me rationalize this.
Well, thank you for having me, Joe. Again, this is an area where it seems that Republicans like to go to, and that is reducing the IRS budget. We've been here, as you recall, back in the spring when we were dealing with the debt limit, increasing the debt limit and finding offsets. Historically, the scoring on this particular issue has always been that if you have additional money that you provide for the IRS to carry out their responsibilities does result in an increase in revenues collected. And so I'm an old CBOer, so I'll be a little biased here, but I think CBO is right that if you're cutting $14 billion out of the IRS budget, then you shouldn't expect then the revenues that were anticipated to come in. So I think this is a unfortunate situation. Literally, as we speak here right now, Joe, the Senate is voting on a Senator Rand Paul amendment to the Senate appropriation bill to reduce the IRS funding, and it's going to fail. So I think we'll get over this. And as you mentioned in your comments earlier, I think the House does not have the votes to use the IRS as an offset. This is an emergency. In the past, when we've had emergencies, yes, we don't usually offset, let's say, disaster spending. And I think this is a critical emergency that I'd like to see it offset, but I'd like to see it offset with real spending reductions as opposed to the IRS budget.
Okay, we'll see if that happens. I'm assuming that we won't get that far with this legislation, but does the Senate lead the way here? Then, Bill, they're looking at a combined appropriations bill that would include the money for Ukraine that I know turns off a lot of House Republicans.
Well, I think we're probably headed toward a situation, Joe, here in about 2.5 weeks when we're up against another possibility of a government shutdown when the current continuing resolution runs out. I think all this is going to get bunched up as it relates to that next continuing resolution around the middle of November, where we'll probably have a situation where we will have both funding for Ukraine and I think Israel. But also, most importantly, as we keep remembering that the president's request does also include about a similar amount, about $14 billion, the same amount for Israel, for border security here in the United States, for new border patrol agents, new immigration judges, and asylum officers and custom officers. So I think where we're headed here is a combination getting up against that deadline on November the 17th, when we'll see this coming to a head once again. I think, yes, I think the Senate's going to play a pretty big role here in terms of what they send over the House. I think this is going to be a major test for the new speaker, and it could lead to here we go again. It could lead to a potential shutdown. But I hope that we can get over this and we can find a solution where we have both the funding that we need here on the domestic side of the equation, or our border security, as well as some disaster response. We keep forgetting that the president not only had a request for the for Israel and Ukraine and border, but he also had something for about a $55 billion for disaster relief. We still have FEMA problems. We still have some issues of sorting with the issues around the child care stabilization fund. So we have a lot. They have a lot to do in a very short amount of time.
I want you to picture this as we understand the Speaker of the House is attending the Senate Republican lunch today. CNN reporting he was flanked by Senators Rick Scott and Ted Budd on the way in and did not answer questions. Does this sound like a meet and greet to you, or a real conversation about what you and I are talking about?
Well, we always have the policy lunches, and I'm not there. I can't say exactly what's going on, but no, I think they have. I think there's a lot of senators who do not know the new speaker, have not met him. This is an opportunity, at least, to have an initial reaction. But I think they will get down. They'll have to get down to some substantive discussion very quickly about where the Senate's headed and where the speaker wants to go, and what they'll be able to work out between the two chambers going forward. Once again, I have to believe this is going to come down to no surprise coming from the Bipartisan Policy Center, that you're going to have to find a solution here that includes both Democrats and Republicans at the end of the day. That may cause, again, problems for the new speaker, as it did for Mr. McCarthy. But this is too important of an issue not to find some quick bipartisan solutions to providing the aid that Israel needs, that Ukraine needs, and our borders need.
We're talking with Bill Hoagland at the Bipartisan Policy Center, and you mentioned the word that I might not have brought up otherwise, and that's shutdown. But it's important to note what's not going to make headlines today, Bill, and that is the House Rules Committee taking up transportation, housing bill, and interior environment spending bill, along with the supplemental budget request. And I know that the Senate is taking up a minibus today. There are actually professionals who should be taken seriously, who are working behind the scenes to do the real work of the legislature. The question is, can they get anything done in time? Do you think this new speaker makes the idea of a shutdown more or less likely?
Well, I think the speaker had made it very clear, and part of his selection process was to agree that the House would pass what we call the 12 regular appropriation bills. And as you say, Joe, they have passed. They still have 7 bills to do. They've outstanding and transportation, legislative branch, financial securities, interior, and agriculture. They still have to do those individual bills, and that's what they're doing in the House. And I think that's what the speaker said he would do. He'd pass those bills individually. The difficulty is going to be that, of course, that's fine. But we have a United States Senate that's also trying to get its 12 bills done, and it has not passed any of them yet. And that's why they're bundling their bills into three packages of 3, and they'll end up, I think, probably they'll have to go to conference and work this out. This is all going to come down once again to another continuing resolution. I don't think there's any question that we're going to have a continuing resolution. I think the Senate has made that clear. I think even the House Speaker expects they'll have to have a continuing resolution. And the question will be that as it was back on October the 1st, will that be at the current level, which caused Mr. McCarthy some problems? But I see they are working their best just to do the basic funding that they have to do for the current fiscal year that we're in, fiscal year 24, that began here a month ago.
Yeah. It's always great to spend time with you, Bill. Do you think the motion to vacate will be beefed up at all? They're going to raise the threshold on this, or is it going to stay the same way it is, looming over this speaker?
Listen, I'm a old Senate staffer, not a House staffer. I can't really comment on the rules and the procedures in the House that much, but I have to believe, having spent, 21 days or so in chaos over in the House, that they do not want to go through that again. And I think that to the extent that the new speaker can at least get his 12 individual appropriation bills done and out of the way, he's got over a first hurdle here that allows him to not face the possibility of another motion to vacate. I just don't believe they want to go through that again. I could be wrong, but I think that they have a speaker now. They want to work with that new speaker, and we'll continue to work on this. I want to remain optimistic that we will get through this difficult time. There are major issues that have to be addressed here, and I hope that we can find a common ground between the House and Senate over the next at least 30 or 40 days.
Bill Hoagland, Bipartisan Policy Center's Senior Vice President, one of our next-door neighbors, almost here in downtown Washington. Great to see you, Bill, as we assemble our panel today. Rick Davis and Jeannie Shanzano are back together, Bloomberg Politics contributors. Rick, he sounds kind of like you. Don't ask me about what's going on in that crazy house. I'm a creature of the Senate. But in this case, the Senate's going to loom large over this process, and I wonder if that's why the speaker is at that GOP luncheon today. What do you think they're talking about?
Yeah, look, this is a normal courtesy that would be granted to any new speaker. It doesn't have much of a footprint on the Senate side. And obviously the things that he is doing right now today are having a pretty dramatic impact on the Senate agenda. You know, even just bifurcating the supplemental bills with trying to take an independent vote on Israel is upsetting the Republican majority or the minority in the Senate. And so I think it was probably like, hey, we need to get him up here and make sure we set our agendas together. So half introduction, half agenda setting. But frankly, because of the time that we have available, probably later than it should have happened, but obviously an important meeting.
When's he going to sit down in the Oval Office, Jeannie?
You hope it is soon. You know, he just hasn't had the opportunity to meet everybody, including the president, even though he is second in line to the presidency. So there should be a meeting and there should be real conversation. You know, he's only been on the job for a week, so it is going to take some time to get up to speed. But those personal introductions are critically important, as is his staffing. You know, the man hasn't even had a chance. He's starting to staff up, but that is a huge challenge.
It's been a hiring spree in the last 24 hours. We can talk about that. We just heard from him on the CBO score. That's next. This is Bloomberg.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 1:21 on Wall Street, so we check the market for you all day long here at Bloomberg. I'm Denise Pellegrini. Stocks are higher. We'll see if they stay this way because it's Fed Day. We'll have live special coverage here on Bloomberg. The Fed Decides with Tom Keene and Lisa Abramowitz coming up in just a few minutes after Sound On. Ed Yardeni, president of Yardeni Research, says the labor market remains relatively hot. We did see that in some data today with surprisingly strong labor market. And Yardeni says don't expect a wildly dovish Fed even into 2024.
I think they're going to say the same story is going to remain intact, which is we're going to remain restrictive. We're not anticipating cutting interest rates anytime soon. And if we do it next year, it's more likely to be 2 cuts rather than 4 cuts.
And Yardeni speaking there on the Bloomberg Surveillance podcast. Stocks, as I mentioned, are higher. The Dow up about 0.2%, up 54 points. The S&P 500 up 0.3%, now 0.4% actually, up 16 points. And the Nasdaq, it is up 0.7%, up 84 points right now. The yield on the 10-year, 4.81%. Spot gold, it's been trading lower all day. Right now, it's down by about 0.2% at $19.78 an ounce. Crude oil, it is higher, but not nearly as higher as it was before. Crude oil right now is just up about 0.4% at $81.28 a barrel. And that is a Bloomberg Business Flash.
You're listening to Bloomberg Sound On with Joe Matthew on Bloomberg Radio.
We just heard from the Speaker of the House, Mike Johnson, for the first time on this new CBO score on the standalone Israel funding bill. This is the one that the CBO said would add almost $27 billion to the budget deficit, remembering that it would be paid for by taking money from the IRS. And this is where we're getting some discord here. $14.3 billion in cuts to IRS funding that was part of the Inflation Reduction Act. Now, the White House already says that it's going to veto this thing if it reaches the president's desk, which apparently it's not because they don't have the votes in the House. The Senate doesn't like it. And the Speaker says, I guess pay no attention to the fine print. Here
Be careful, everybody be careful.
Were you surprised by the CBO score, sir?
Not surprised at all. Only in Washington, when you cut spending, do they call it an increase in the deficit.
Only in Washington, when you cut spending, do they call it an increase in the deficit. Let's assemble our panel for their take. Jeannie Shanzano and Rick Davis are with us. The math is difficult to argue with here. Rick, am I missing something?
Yeah, I think the political overlay to this, right? The American public hears that the Speaker is trying to cut funding. Maybe a little of that seeps into, oh, by the way, it's the IRS. And virtually none of that will go to, oh, the CBO says that'll increase the deficit. I mean, like, CBO doesn't have a mouthpiece like the Speaker does.
Mm-hmm. But then there's reality, right, Jeannie?
That's right. And we talked about this yesterday. And so only somebody trying to play political games, and not very effectively, by the way, would try to pull the wool over people's eyes and pretend that they didn't realize that cutting this money to the IRS would actually decrease revenue and increase the deficit. It is a pay for it that doesn't pay for anything. We do need to pay for our spending, but you have to do it in a fiscally responsible way. And even somebody, I don't know, in maybe 3rd grade math can figure out that when you cut IRS enforcement, you diminish our ability to collect money that the government needs to keep funded. And so Mike Johnson should know that. I am terribly concerned if he doesn't realize that, but I think he realizes it, and he's trying to play political games. And the politics aside, all thinking people realize this is the reality. It doesn't take a math genius. This has nothing to do with Washington. This is to do with Mike Johnson trying to play political games. Fiscally responsible people don't do this. Just look at Tom Massey, a very conservative guy who said this is not fiscally responsible. It will add to the deficit. Even Marjorie Taylor Greene said the same thing. So, he's got to go back to the table on this. Let's find some real cuts for the new speaker so he can move ahead.
We know we're in trouble when Jeannie's quoting Marjorie Taylor Greene, Rick. I don't know what you want to do with that, but I will point you to the Republican Accountability Project. Rick Davis, what do you think of this? A six-figure ad campaign to shame Speaker Johnson over his efforts to overturn the 2020 election. This is another part of course, the narrative in his first full week on the job that we're hearing a lot more about, the amicus brief that he wrote that would have brought from the state of Texas these results to the Supreme Court. Here's just a taste of this ad. It's going to be running in prime time on Fox News.
Republican Mike Johnson just became Speaker of the House, but he's the last person who should be leading Congress. After Donald Trump lost the election, Johnson started pushing Trump's big lie, pressuring the Supreme Court to overturn the will of voters in 4 states. And after
they go on to call him a danger to our democracy, Rick. I could keep this thing running, but I'm sure we'll all be inundated by the ad if we're watching cable news. Who's this resonating with? You mentioned the lack of a megaphone at the CBO. Will this get into the right living rooms? Will it make a dent?
It'll get into some. I mean, they've obviously targeted the right states, Georgia, Arizona, Michigan, Pennsylvania, Wisconsin. I mean, that's where the fight's going to be for a presidential election. And by the way, all of a sudden we have a new speaker who nobody's ever heard of, which means they don't hate him yet. Voters hated Nancy Pelosi. Voters hated, McCarthy. Voters hate our leaders because they have to go through all this kind of negative campaign advertising. And here's this guy Johnson no one's ever heard of. They haven't learned to hate him yet. So this is step one in teaching people to hate, Speaker Johnson. It's critically important that the Democrats are able to demonize Republican leadership. And Mitch McConnell's kind of hard to argue with. He's doing a lot of business with Democrats these days, so they're going to have to find someone to be the target. And Johnson's time in the barrel is now.
It's time in the barrel, Jeannie. How long is it going to last?
I think it will last. I have long thought that it's really, really tough to demonize the new speaker because his personality doesn't really play with that. It was far easier for the Republicans to demonize Nancy Pelosi than it's going to be to demonize somebody like Mike Johnson. His personality is, quite frankly, a lot more like somebody like our former vice president, Mike Pence. And I think that's going to make it tough. Now, or is he going to go through vetting? Are people going to look back at what he's done? All of that is fair game. All of the things that he has said, he hasn't been vetted as most speakers would be. And so a lot of this is new. But I think unless he changes his tone in a distinct way, that demonization is going to be hard. But I do think anybody who plays a role in trying to say the 2020 election was stolen, that is fair game to say, look, folks, this is who is leading this party. Do you feel safe putting your trust in this party to run the House? I think that's fair game. He's the one who led the charge quietly as he did.
Well, when you go big picture, Rick, and in just 2 minutes, we're going to start special coverage of the Federal Reserve meeting today. And you look at that Bloomberg poll that we've talked a lot about with Morning Consult, looking at these 7 swing states that are critical, some of which will have that ad running in them. The economy ends up being the number 1 issue. And is this why no one seems to be dwelling on 2020?
Yeah, I think 2020 is, the only person who's dwelling on 2020 is Donald Trump, and the Democrats couldn't be happier about that. That's what they want.
That's quite a point.
But everybody else is like moving on. And Democrats are using a lot of the issues to their success from 2020. We see it in advertisings everywhere here in Virginia for the legislative elections that are next week. Abortion, 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 right? I mean, those Republicans are going to take away your rights. And so we know where they're headed, and Republicans are talking about the economy. So, money's on the economy, and that's where I think the 2024 election will be prosecuted at. That's why Biden's going to Wisconsin to talk about the economy and bringing jobs to rural America, trying to get some of those blue-collar jobs back. So you see it playing out in real time, but I would say, shooting your bullets on, Speaker Johnson in a presidential targeted state doesn't make much sense. If they think it's going to be Trump, they ought to be shooting at him.
How about that? Rick Davis and Jeannie Shanzano, great conversation on what is truly the fastest show in politics today, because we've got a Federal Reserve announcement coming up here, and I want to thank you both for great insights, as always. Our signature panel, Bloomberg Politics contributors, Rick Davis and Jeannie Shanzano. I'm Joe Matthew in Washington, where tomorrow it's going to be inflation, 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 right? Let's head to New York now. In a special edition of Bloomberg Surveillance, the Fed decides, with the voices you trust. Tom Keene, Lisa Abramowitz, live on Bloomberg.
From New York City, for our viewers worldwide, Bloomberg's The Fed Decides. It starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Keene, on the afternoon, it is The Fed Decides. There's a countdown clock. We don't have that in the morning. We welcome all of you. John Farrell on assignment. Spoke to him, though. He looks for a rate cut.
Oh, is that so?
John Farrell, he looks for a rate cut. We'll see if we get that.
See if he finds it.
As well. The news is moving, including a really important op-ed piece to get us started here. We'll get to that in a moment. Lisa, your thoughts as we go into this meeting and the key press conference.
There are a number of key questions that I think are percolating out there. Number one, how hawkish can the Fed be without hiking rates further? Because if people are talking about a hawkish pause, is the Fed behind the curve when it comes to inflation? Can we get down to 2% inflation without more pain in the economy? And then, of course, geopolitics. I am curious to see whether it's inflationary
he's got to have
or
a statement.
disinflationary. He said it last time, so he's going to weigh in this time around.
It's going to be fascinating, folks. It's become more fascinating in the last 24 hours. I was sort of like snooze fest. And I was wrong. There's a lot of tension here in the data check. We'll get to that. Green on the screen. We started red on the screen early this morning. This afternoon with futures, they're up 13. The VIX 17.63. Some movement in bonds. But I got a DXY at 107. The global economy is speaking about this Fed meeting, and that global economy says strong dollar.
There is a divergence in the U.S. economy with the rest of the world. We have seen that continually. We saw that before when it came to Europe coming out with a recessionary outlook, but disinflation. Does the U.S. have too much growth? That, I think, is what people are grappling with. Coming up, just to give you a sense of what we have on deck, because we have an amazing roster of guests to weigh in on what some people call the Super Bowl of economic days. The former Vice Chair of the Federal Reserve, PIMCO's Richard Clarida, will be joining us, plus Matt Lazzetti of Deutsche Bank. Then at 2 p.m. Eastern, immediate reaction from KPMG's Diane Swank, Morgan Stanley's Matt Hornbach, Kathy Jones of Charles Schwab, and Greg Peters of PGIM Fixed Income. And finally, breaking down Chair Powell's news conference, we have former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg. To me, this is going to be a pivotal moment, Tom, not just in terms of what the Fed says, but how it's taken by the market.
Bill Dudley agrees with you. Let's go to an important op-ed by the former head of the New York Fed, and of course his tenure of duty at Goldman Sachs as well. This is really, really a key comment here from Mr. Dudley. In the 1980s, Volcker had to inflict a severe recession on the United States to undo the mistakes of Arthur Burns, who allowed inflation to get out of control in the 70s. Powell, Chairman Powell, is amply aware of the history. Nonetheless, he's risking a repeat. We're going to go with Priya Misra here in a moment, but Lisa, your thoughts on this fiery essay by Dudley, who will join us later.
He's on to something. I mean, he has been. He's been ahead of the curve in terms of calling for rates to be higher. We have seen JOLTS report coming. The JOLTS report earlier today came out stronger than expected. We saw ECI, the Employment Cost Index, hotter than expected. Are we seeing enough disinflation? Are we really seeing enough loss in the momentum in the labor market?
Speaking of loss, I got a market up 24 Dow points. I got some SPX up 0.3%. Keefe Bruyette & Woods Bank Index, it's slightly south this morning. Let's begin. Priya Misra with his portfolio manager, JP Morgan Asset Management. Priya, you nailed the inversion. Now we have a disinversion. Will we fully disinvert where that 10-year yield finally is higher than the 2-year yield?
I think for a true disinversion or a positively sloped yield curve, I actually think the Fed needs to start to cut rates. I think this bear steepening has sort of run its course. So for really the next leg of steepening, the next 100, 200 basis points, I think the economic data has to be a lot weaker and the Fed has to be more open about starting to cut rates. So I think we have to be a little patient on the yield curve here. When we start to see data, which in our view is going to happen over the next 6 to 12 months, data that's weak enough that the Fed will have to start to signal that maybe they've gone too far. I think that's when the curve will become positively sloped. But we've come a pretty long way here. I think the next move is actually lower rates rather than, further sort of steepening of the yield curve.
What are you seeing in the data that supports that, given the fact that we see job openings ticking up unexpectedly, that we see employment cost index going up relative to expectations? How do you justify a softening?
So that's a fair point. If you look at data, it's been strong. Second quarter was strong, third quarter was strong. The last month of data has actually come in stronger than what most people were looking for. But I think, is this noise or is this a re-acceleration? When I look at financial conditions, I look at real rates. Look at how high real rates are. 10-year real rates, 2.5%. I mean, that is restrictive. We're well within restrictive territory. It just needs some more time. The famous long and variable lags, I think they're playing out. We're coming off extremely low level of real rates. And so if consumers, if corporates have essentially termed out their debt, it's going to take some time. We're seeing cracks, developing in terms of credit card delinquencies, debt levels. Why is the consumer taking on more debt? I also think that the labor momentum is starting to slow down. So as the job market softens and, consumers realize that debt that they're taking on is actually expensive and becoming more expensive by the day, I think there's going to be a reduction in spending. That's essentially what's going to then turn this virtuous cycle of the labor market and spending into a more negative cycle. And I think we're seeing early signs. It looks like a soft landing right now, but I would caution every hard landing starts looking like a soft landing first.
Priya, do you think that it has helped or hurt the Federal Reserve that they've been talking about the long end of the yield curve doing the work for them?
I think they're trying to buy time. They have to strike, Chair Powell has to strike this very fine balance here between sounding vigilant on inflation. They're sure that they want that 2% target and that they remain committed to it. And then being cautious because they need for these lags to play out. They know that they've done a lot. And now that the long end has moved, I would argue that the economy is a lot more sensitive to long end real rates. Long end real rates have significantly increased. Financial conditions have tightened. You look at bank lending surveys, they're tightening. So I think the Fed has to, which is why it's going to be a very tricky Fed message, I think, today, where they're going to try and sort of walk this tightrope, but buy time. I think they want to see how policy that they have tightened significantly, how is that playing out in the economy? And I think you sometimes need time for this.
Right. Priya, you're at JP Morgan, and it's called Fortress Diamond, but really, folks, what it's called is Fortress Michael. And you guys are sitting around a bond table there in asset management, and you've got to ask, look at the banking industry, not JP Morgan, but look at the blended Keefe-Bruyette & Woods index. And the word I used this morning is the stock market of banks is grim. Is this chairman going to be distracted in the press conference about what to or what not to say about American banking?
I think Chair Powell has to acknowledge that credit conditions are tightening. Can the capital market take the place of the banks to some extent? Yes. But, is that enough to offset where the banks seem to be pulling back? If the banks are dealing with, deposit outflows and inverted yield curve, I think that's arguing for less loan growth. And that is negative. Now, partly it is the intended consequence of tightening. I think when the Fed starts to raise rates, remember, they're also doing QT. That's tightening policy every single day. They are trying to tighten conditions to slow the economy down. But they have to be careful. Is the market running away with that narrative? Which is why I think we've seen a subtle, I would argue, shift in the Fed reaction function. They are acknowledging the big tightening in credit conditions and financial conditions. So, I wouldn't say that it's all that's all that matters. I think the Fed is looking at economic data, which includes inflation. And I do think some of the inflation trends are moderating, as well as financial conditions. And they need to see how the two are interplaying, what the interplay between those two are for the real economy.
Priya Misra, always wonderful to get your view. Thank you so much for being with us. And Tom, you have been talking about the banks, and I think it's really a well-taken point, because that is the credit transmission mechanism for a lot of small businesses, for a lot of individuals, particularly the regionals that have been in a world of hurt.
I can't say enough about that idea of it being the transmission mechanism. And Mark Cabana of Bank of America this morning was incendiary about the place of the banks now. He says they are building cash because of the unknowns. And I just think the Federal Reserve and frankly other Washington institutions have to be front and center, not about the memory of the spring, but what the new memory will be of Q4 with these banks as they get to year end and have to account for a difficult challenge.
And you love this discussion, the long and variable lags, and just how much that's going to end up being part of the conversation, because essentially that's what they're saying. Just wait for it, and that will suddenly slam into reality.
I think the long and variable lags are simple. High yields are killing them, and you can go higher for longer, higher for shorter. I like normal for longer, maybe as one theory as well, but these are the conversations we're going to have today. Let's set this up right now. We got 20 minutes till we get to the announcement. Michael McKee, I believe, will stop by. And we've got a whole bunch of other people coming up. Lisa will tell you about that. The data. We're in 12 ginormous basis points in the 10-year yield, 481, the 30-year bond under 5%. Even the 2-year yield down 7 basis points, 5.02%. Lisa, the market on the move before this Fed meeting.
Coming up, so pleased to say, former Vice Chair for the Federal Reserve, PIMCO's Rich Clarida joining, plus Deutsche Bank's Matt Lazzetti. That conversation with both of those tremendous individuals coming up next.
This story did come around as something that's a bit different. There is a dark side to it.
It's hard to even talk to people about these chemicals and tell them, look, there's a chemical that's in you that's not found anywhere in nature.
We've all been used as guinea pigs for the last 70 to 80 years. We weren't told we were being exposed, but they did it anyway.
This right here is the shadow fleet. To actually see clandestine behavior was really surprising. That makes you think, well, what else is going on?
A lot of people let Agnes down. What she was told is exactly what happened to her.
It took the lid off a much bigger problem. I think that's probably the most shocking part of this whole thing.
The Fed is going to hold
the course.
We'll have a more hawkish hold.
A very hawkish tone, but a pause.
It's pretty much consensus.
We're not expecting a surprise.
High for long will still be an important part of the narrative.
Beating that drum of higher for longer.
The continued strength of the economy actually handcuffs the Fed.
Economic data in the U.S. has been quite resilient. The resilience of businesses, the resilience of the consumer.
The labor market that is just, very strong.
The Fed is looking at all of these data that juxtaposed with inflation that's still too high.
Communication is still that inflation's too high.
The Fed is probably going to want to keep its options open to hike more.
Unless Jay Powell diverges widely from that narrative, I don't think this Fed meeting is a big market mover.
I don't think it'll be an uninteresting meeting.
These FOMC meetings, these are like playoff games.
Welcome to the playoffs. This is Countdown to the Fed Decides on Bloomberg TV and radio. I'm Lisa Abramowitz. I do too, and he's right on in terms of how people are looking at this particular meeting, although the markets are set up after really talking about the refunding agreement. I know, Tom, you probably were thinking maybe we could get away with that now that we're in the Fed meeting and we don't have to think about, the refunding announcement that came out earlier that really whipsawed a lot of things.
It goes to the number of narratives that are out there right now. We've got to do a market check because things are moving here. We've got two important guests. How do you begin your year-end outlook? If you're Matt Lazzetti at Deutsche Bank, he's got to pop 32 pages off. He can't, plagiarize Clarida over at Columbia. Lazzetti's got to pop off a year-end outlook. Do you do it on November 1 or do you wait for December 13th?
I think that you wait for March 31st and do the backward look.
Exactly.
What we're seeing, though, in markets definitely is green, given the fact that people are pushing into risk following their bid to bonds. I don't get that out, given the fact that seems to be a little bit of nervousness taken off the table with some disappointing ISM data, Tom, as well as a refunding announcement that wasn't quite as significant in the long end that people expected.
We're going to go quickly here. We have two wonderful guests now to prepare us for the Fed meeting, and then Michael McKee at the press conference as well. Richard Clarida is with PIMCO. He's Global Economic Advisor, yes, the former Vice Chairman of the Federal Reserve System, but far more holding court at Columbia, herding Nobel laureates for Columbia economics and also providing original research on the dynamic natures of our American economy. Matt Lazzetti out of UCLA is Chief U.S. Economist at Deutsche Bank on a tight timeline here. Vice Chairman, let me go to you first here. As you look at this meeting, and as Bill Dudley says for Bloomberg Opinion today, this is a meeting and a set of meetings fraught with risk for Chairman Powell. What is the major risk the chairman faces?
Well, Tom, I think he has a communications risk. I don't think we're going to get any news in terms of either the decision or the statement at 2 o'clock, but I do think this is a high-stakes press conference because there's a meeting coming up in just 6 weeks in December. In September, 12 folks on the committee thought they'd need to hike once more. That's the camp I'm in. If I were still there, I would think at least one more hike is needed. But right now, market is not really pricing that in. And so I think he needs to discuss today's meeting, but also to tee up his outlook for the next meeting.
Matt Lazzetti, we had Priya Misra on with her great call on deep inversion early in the year. You have the mother of all calls. You were out front saying recession is distant. I've got a GDP Q3 going to a GDP at Q4, which is in the Lazzetti recession direction. Do we have a recession coming up as we address this meeting?
Look, I don't think it's going to be the focus of today's meeting. I think the focus will be the strength in the data that we've really seen since September. We've had a strong jobs report. You had a strong retail sales report. You had an inflation report that was showing some strength. Just this week, we saw job openings remaining high and the employment cost index with some strength. So I think it really is about the Fed not raising rates today, keeping up their optionality to raise rates in December. And really, if they do need to raise rates again, I'm not convinced that they are done with just one and done. You could see some resilience in the data that remains, and it'll depend on whether or not financial conditions remain very tight and continue to do the Fed's work.
Matt, what's your one question to Fed Chair Jay Powell?
I think an interesting one from my perspective is there's a lot of parallels today to what happened back in March, which is that the Fed is not raising rates or being less aggressive because they're looking at the tightening of financial conditions that are taking place. But what we learned back in March is that it didn't come through and flow through to the economy as much as we might have thought. And so is there a risk here that they are moving in a somewhat more dovish direction? But the financial conditions tightening that they're anticipating doesn't feed through to the economy and risk that they have to do more later.
Matt Lazzetti, one final question. Is this a collegial board or are there deep divisions as we see at the Bank of England and among the nations of Europe?
Look, I think they've been remarkably cohesive in decisions over the past 18 months. I think as we look ahead, it's just natural that there's going to be more disagreement. I think you're getting to the point where two-sided risks are more real. The risk of over-tightening will become more significant. The risk of under-tightening will be more significant. And so I anticipate that as we look ahead, there will be more disagreements. But I think Chair Powell is very clear. The number one metric from their perspective is that they get inflation back down to target over time. I think that it will, what we're seeing today is that it might take further tightening from their perspective. and that while getting inflation down to 3% didn't take much pain, getting from 3 down to 2% might take a little bit more pain within the economy and labor market.
And that's definitely what's keeping up a lot of people at night. Matt Lazzetti, thank you so much for being with us. This is the countdown to the Fed decides on Bloomberg TV and radio. We're moments away from a Fed rate decision. Still with us, we are so glad to say, Rich Clarida, the former Fed Vice Chair. Rich, I want to pose that question to you that Matt Lazzetti was just talking about. Are we on the brink of another March 2023 moment where the Fed pulls away from raising rates, even in the face of hotter than expected data?
Well, obviously, other things were going on in March. Later on, we had SVB and the like. I do think, and I give the committee credit for getting off, the rate hike hamster wheel, and so they've shown that they can both hike and pause. And I certainly, if I were there, would be okay with a pause today. But I hope it's a hawkish pause, because I'm with Matt. The progress that we had seen on inflation has stalled a bit. The labor market is still red hot, which is a good thing, but wage gains are really not consistent with the inflation target. So I think the messaging needs to convey that determination.
Rich Clarida, April 4th of this year, writing for The Economist, the former vice chairman, but it is likely to be something more like 2 point something than 2.0. Drag us forward from April 4th when you shook the economic world. Is 2 point something 2.5, or does John Williams need to get used to 2.9?
Well, look, what I'm trying to communicate is that the Fed's primary goal since March of 2022 has been to get inflation substantially lower. It was running at 5. It's now running in the low 3s. I am of the view that if next year in 2024 inflation's running at 2 point something, and point something could be 0.5, 0.6, or 0.7, they will say, look, we've made a lot of progress. We can start to dial back and start to adjust rates downward. Chris Waller's done a good job of explaining that. It'll be a nuanced message, but I think it'll be the correct message. But we can't put the cart before the horse. We have to get inflation down to 2 point something on a year-over-year basis, and we're not there yet.
Richard Clarida, we'd say, lower Milton Friedman, we're going to go out longer with variable lags and all this. That's from another time and place. Forward here for Chairman Powell in all, do we have an America that is together where we have a common economic theory, or is this a Fed making it up as they go, including here at 2 p.m.?
Well, Tom, I think you may be onto something. Maybe I wouldn't put it quite that way, but I do think central banks, the Fed and other central banks, are about to enter a period where there's going to be an active public debate on the merits of the inflation target. Right now, inflation is very unpopular. Everybody wants lower inflation, but so far we haven't really seen any consequences in terms of higher unemployment. At some point, the Powell Fed may run into that trade-off, and given the nature of what else is going on in the country right now, that could be a divisive discussion.
Right now, we're looking at a myriad number of issues, including geopolitics. We heard Jay Powell talk about this in the past number of weeks, where he did raise this as something they're watching and seemed to indicate that it was disinflationary, not an inflationary potential shock, the way that others have been received. What do you make of that? What do you expect him to say today on that front?
I think that he probably won't try to break a lot of new ground. Fed officials always want to acknowledge when there are the geopolitical tensions. They don't want to get too into the details of how they're factoring that in. Typically when there's war in the Middle East, it tends to lead to higher oil prices, and so there's a pretty standard playbook for thinking about that. But also, over time, if it accumulates, it gets into risk appetite, it gets into animal spirits. I frankly think it's too soon to tell how this is going to play out, so I think he would stay away from it.
Richard Clarida, at this meeting, at this press conference, to the December meeting in January 31, I would suggest post-pandemic we find a new science of monetary policy. You wrote about this years ago. What is our new science of monetary policy that Chairman Powell right now has to confront?
Well, I think he has to confront that in the rearview mirror, inflation's been too damn high. The Fed and other central banks want it to be around 2%, and the longer inflation remains above that target, the more central bank credibility is threatened. And so far, I think the Powell Fed has done a good job of keeping inflation expectations anchored. But to your point, Tom, in Clarida Galley-Gertler, our model essentially looked at a situation where central banks were credible because in the past they'd achieved their goals.
Right.
It's a little bit more complex model when you've not done that for 3 years.
But the heart of the matter post-pandemic is Bill Dudley says we have a risk of becoming unanchored. At this meeting, does that need to be addressed? That confidence building, does that need to be addressed in the press conference?
Tom, I don't think so at this press conference because I think so far inflation expectations are reasonably well anchored. But I think the chair will say, as he has many times, including with David Weston not too long ago, that they are determined ultimately to bring inflation down to 2%. But no, I don't think he needs to address that specifically today.
He does, though, maybe have to nod at his belief, which is a huge academic question, of whether we need to see more pain in order to get inflation down under control. And we're kind of addressing this from all different angles. What do you think the answer is? Have we gotten anything that gives you a sense of whether we've seen the kind of pain in the U.S. economy to get us back to 2%?
Well, Lisa, I am in the camp that it's going to take somewhat more slack in the labor market, which is euphemism for pain in the labor market, than the Fed's September projection. September, the median participants saw the unemployment rate peaking around 4.1. That would be great, but I think given how hot the labor market is and how stubborn inflation appears to be in the 3s where they want it in the 2s, I think we are going to need to see some more slack. Now, it may just be slower growth. Maybe Governor Waller's right and the adjustment can occur in job postings and quits, but you saw today the JOLTS numbers are also going in the wrong direction. So I do think it's going to probably take somewhat more pain than the committee seems to think right now.
And just quickly, what do you think the risk is that the Fed is losing its credibility and is behind the curve in a more meaningful way and needs to take an even more aggressive stance to counteract that?
Lisa, I don't think we're here now, and I don't think we're likely to be here in December, but I think it is a real risk in 2024. We could be sitting going into the May Fed meeting with inflation moving up, not down, with the labor market hot, and with a committee that may need to re-engage. I don't think that's the most likely case, but I think it is a significant risk. And I think implicitly you heard that from Lizzetti, and I think that's in Dudley's piece as well this morning.
Rich Clarida, you're sticking with us, which we really appreciate. We are just about 2 minutes away from the Fed rate decision, which is published at 2 p.m. And then after that, a half an hour after that, we hear from Fed Chair Jay Powell. A lift to the market, NASDAQ up 0.6%, the S&P up at 0.4%. Big? I guess it's big after 3 straight months of losses, right? I mean, I guess that, but it's really come from the drama in the bonds, which have been jerking around
13
everything.
basis points. Wow.
That is a massive move. We're seeing some really big moves in the 30-year bond in particular after the refunding agreement, but really the 10-year yield still sticking down almost 13 basis points to 4.8%.
In Clarida, with PIMCO and Ambrose Evans Pritchard over at the Telegraph, his lead right now, this is in the last hour of the British evening, inflation is dying and bonds are screaming buy. You and I heard that from Ian Lingen at BMO Capital Markets 2 months ago.
The problem is that a lot of the data has come in hotter than expected, and even in the earnings, we've seen this idea of prices going up and volumes also going up at the likes of McDonald's, at the likes of Caterpillar.
I will say this, in many a Fed meeting, this is the most active Bloomberg terminal I have seen. We sort of look at it, and of course, with the morning we've had, our eyes are glazing over right now. We're looking at the blinking red and green, and there is a real pulse to this market across equities, across bonds, across currencies, across commodities as we speak. You've got a NASDAQ 100, those tech stocks, those long duration stocks leading the way up 0.8% on the NASDAQ 100. We have ginormous moves of optimism. Buy bonds, price up, yield down as well, 4.81%, Lisa, down, lower yields.
And this really is driving a lot of the appetite, but in the dollar, you are seeing the strength of the U.S. economy. Let's head over to Bloomberg's Michael McKee with the headlines. Mike.
No surprises, no news. A few new words. In a unanimous decision, the Fed retains its 5.25% to 5.5% target range for its benchmark borrowing rate and retains its language about determining the extent of additional policy firming that may be appropriate. The policymakers' assessment of the economy contains some new adjectives, but no new information. Activity expanded at a strong pace in the third quarter instead of solid. Job gains have moderated instead of slowed. Inflation remains elevated. The statement says tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. That adds the word financial to the sentence, and it may be a nod to the idea expressed by many Fed officials that raising market rates are doing some of the Fed's work for it, a reason not to have raised rates today. This is the second meeting in a row that the Fed has held rates unchanged, and although the dot plot suggests one more move by the end of the year, the markets may interpret today's decision as confirming that rates have peaked. That's going to be a key question for Chairman Jay Powell coming up.
You see, Mike McKee, we want to get to you quickly here, but we see the market moving, lifting up, equities lifting up higher right now, with the Dow up 80 points, 0.2%, NASDAQ 100 on a tear up 0.8% as well. The 10-year yield comes in ever lower, bond prices up, yields down on the 10-year yield 4.79%, distant from the 5% yield. Mike, the statement is here, and maybe it's a preparation for December 15th, but it seems to be a preparation for a presumed slower American economy. Into this press conference, do you assume we go from 4.x% Q3 down to something dramatically weaker in this present quarter?
I don't think the Fed is going to put it that way. They took recession out of their forecast a meeting or two ago and basically have said that the economy can grow at a reasonable rate without going into recession. Now, Jay Powell has suggested we still need a period of below-trend growth. We're nowhere near that now. If we do see it slow down, the question is, does it go too far, too fast? Right now, all indications are it wouldn't, that we could see slower growth without seeing recession, and we could see inflation continue to come down. But that's a question for them. Are they in damage control right now, making sure that they don't go too far because they think the economy is going to slow, or do they think they've done enough at this point?
Michael McKee, thank you so much. We'll be catching up with you throughout the afternoon. Just taking a look at what's going on, the 2-year yield to me, Tom, really stands out.
Yes.
Sharply down, below 5%, as really, to Mike's point, the market is taking this as the Fed is done hiking rates for this economic
40
cycle.
headlines out now. Mike McKee will have much more on this, as well as our guest. But Lyle Brainerd showed up for the Fed meeting today. She's at the White House now, holding court as National Economic Advisor. And let me read this headline. It's a Brainerd headline. Fed repeats it will take a cumulative tightening and lags into account. Draghi would have just said, we're going out to 2025.
Well, and we're not going to hike anymore, because if you think about the cumulative rate hikes, have we seen enough from what already has been done, or is this the long and variable lags that a lot of people are talking about?
Richard Clarida with us still. He is with PIMCO and Columbia University. Richard Clarida, I look at cumulative, and that just tells me we're going out there. Draghi would have put a date on it. Can Professor Clarida put a date on this longer Fed at this level?
Well, I don't think so. I think, the language cumulative has been in there for several meetings, and it does recognize that the path forward depends upon how much they've done in the past. As I've said, these are always balancing acts. I think the Fed's baseline outlook makes a lot of sense, but if there is a risk, the risk is that inflation is too stubborn. If I were recommending or talking to Jay Powell, I would recommend that he leave the door open to doing more. He doesn't have to commit to it. Every meeting's live, but I definitely don't think he wants to walk away today with markets seeing the headline as Fed is done.
That seems to be certainly at least the initial read on this. One line that Michael McKee pulled out was that tighter financial as well as credit conditions are set to weigh on the economy. They added financial into this. How much do you think the Federal Reserve and the members are concerned about some of the volatility we've seen on the long end of the curve, that maybe it's getting to something a little dysfunctional, a little bit less just nicely restrictive?
Yeah, well, the short answer is there's probably a range of opinions, but certainly Chair Powell recently and Lori Logan, President of Dallas, have indicated that it reflects, it is doing some of the Fed's job for it. They haven't pushed back against it. I do think that the challenge, having wordsmithed with others some of these things, the challenge with putting the financial conditions term in this statement is, financial conditions can go up and down and be volatile for a lot of reasons, and then at some point they may regret that they included it in the first place.
Vice Chairman, thank you so much. He's a former Vice Chairman of the Federal Reserve System.
He's sticking with us.
He's going to stay with us?
Yeah.
Okay, I did not know that. That is very good. Rich Clarida, thank you for the generous time today, given your responsibilities at PIMCO. Joining us now, Diane Swank, Chief Economist, KPMG, and Matthew Hornbach with his Global Head of Macro Strategy at Morgan Stanley. Diane Swank, we're talking rates, we're talking inflation. I believe there's an employment mandate as well, and part of that, to all of your Midwestern heritage, are auto workers better paid? How do we have wage disinflation if we have unions garnering these historic pay raises?
Well, first of all, I want to echo what Rich said. Is our concern is sort of around May and June, where is the Fed going to be? And I think the optionality to have rate hikes still on the table and that every meeting's live is really important. So I really agree 100% with Rich on that. I think the issue on the UAW strikes and what they have seemed to have gotten is that, first of all, union contracts were lagging private sector contracts during much of the expansion and the frenzied hiring boom. And so some of this is catch up. I think also it's important that there will be spillover effects in the manufacturing sector more broadly. The key issue is how much will those higher wages spill over into other manufacturers. That's yet to see, but I do think that's where the tension could show up. And it's yet to happen. And so they're going to ratify it. These were good contracts and a good win for the UAW, harder for the automakers. But I do think what's important to understand is that many of these contracted wages in the public sector as well are just now beginning to reset and catch up to where the private sector already was several years ago.
Matt Hornbach, what all that Lisa and I have done today, the single moment for me was your Seth Carpenter explaining the Zentner deceleration in this economy from 4.x%, I know, inventories and that, down to something sub 1%. In the Q4. What do our markets do with that deceleration presumed in real GDP?
Yeah, well, thanks for having me on the program, Tom. I do think that the deceleration will be important and factor into how the Fed thinks about this higher for longer mantra. I mean, it's true that the meeting today didn't really offer too many surprises, but we do have one more meeting before the end of the year, and even though we don't expect the Fed to be hiking rates at that meeting, there is an open question about what they do with their guidance that comes in the dot plot. That I do think is going to be levered to the growth outlook. And if we do get this deceleration that Ellen and Seth are looking for, then I would suspect that the Fed may have to take a slightly more dovish approach to their outlook for interest rates in 2024 and beyond.
Very importantly, Lisa, the two-year yield breaks down to a new low on the two-year yield, as you mentioned earlier, in 10 basis points, now in rounded up on 11 basis points, 4.98%.
This raises this question, how do you have a hawkish pause if a pause is a pause? Matt, what's your view? I mean, how much can really Fed Chair Jay Powell lean into this idea that they may not be done without the market saying, yeah, you've been following us all year?
Yeah, Lisa, look, I think that what will be key is Powell focusing on the data dependence of the Fed. We just got through a pretty strong round of data for the month of September. We've got 2 more months of data before the Fed convenes in December. And then again, that dot plot, I do think is going to be an important signaling mechanism. To the extent that they are done hiking rates, they can always double down on the higher for longer theme by taking all of the rate cuts out of 2024. So that's going to be an important variable that investors will be paying attention to.
Diane, how much are you looking at the reliance on financial markets to do the work for them at a time when things are volatile? And to Rich Clarida's point, financial conditions can change. How much is that not exactly a comfortable place for the Federal Reserve to be in?
Well, I agree 100% with Rich on that, and so I guess Rich and I are just in 100% agreement today, but I think that is going to be a danger for the Fed because they're looking for this doing the heavy lifting for them. It is obviously already throwing a bucket of ice on the housing market. That's going to come up in the fourth quarter. That said, the consumer is remarkably resilient. We've got double the savings we thought we had with the benchmark revisions, and it's getting interest paid on it now. That is really important to take into account. And the strength of the economy, I think we're going to see a deceleration it's hard not to, from almost 5% in the fourth quarter, but the consumer is still going to be pretty strong. We're set up to have pretty strong gains still with 2.5% or so gains in consumer spending. The strength of the economy justifies higher rates, and it also brings into question how much restriction we have. And if financial conditions were to unwind and the rout in the bond market were to unwind, that takes away the restriction that's out there, and all of a sudden the Fed has to get back in the game. And so that optionality of being every meeting live, critical.
Rich Clarida, what's so important to me is, again, the analog that we're conveniently using of taking Powell back to Volcker. And as Bill Dudley writes an hour ago for Bloomberg, he says the arch fear was Arthur Burns, who allowed inflation to get out of control in the 1970s. I believe we have a disinflation vector, but should we fear that inflation is out of control?
Well, the analogy I would use, which I think the Fed would want to avoid at all costs, is 1966. LBJ had guns and butter, inflation was moving up, the Fed hiked, and then they blinked, and they cut in 1967, and what we now call the Great Inflation, I think, stems back to a hiking episode that got cut short, and the Fed did not re-engage when inflation went up. I don't think the Powell Fed would make the same mistake, but that's the part of the history book I'd be looking at and trying to avoid.
Matt, when we take a look at how the market is handling this, we're not talking at all about the balance sheet. Should we be? I mean, is that part of the discussion in a material way?
Well, Lisa, I do think that the balance sheet will be an important topic to discuss in 2024, but that's, to us, probably a bit more of a second half of next year issue as opposed to a first half issue. Nevertheless, we will see the Fed's balance sheet continue to shrink in terms of its securities holdings. The issue that we would be focused on here is what ends up happening with the BTFP, that term funding facility that the Fed introduced back in March, to see what kind of take-up we end up getting through the first several months of 2024. I do think that will be an important factor that we should all continue to pay attention to.
Diane Swank, to pick up on what Matt Hornbuck just talked about, and of course we see this in Japan with the arch debate even into this evening. Pay attention, folks. Bloomberg Asia, Yvonne Mann and the rest over in Hong Kong following Japan in their odd economic experiment. Diane Swank, are we going to successfully extricate ourselves from, what did Nora Rubini call it? QE1, QE2, QE3, 4, 5, 6. I mean, Diane Swank, where are we? I mean, McKee's encyclopedic on this. I don't get it. Are we going to get ourselves out of this QE-QT model successfully?
That's a big question. I'd love to hear Rich's response on that one. I think, what's interesting is the Fed wants to stop is likely to stop short of their objective in terms of how much they drain their balance sheet. That said, the quantitative tightening, the reductions in their bloated balance sheet, they're still going to stop at a level that's much higher than it was in the past. And what we've seen is anytime there is a financial crisis, this is something the Fed, once we get down to the zero boundary, we have to rely on. Now, the one thing that might be hopeful for the future is that it looks like the non-inflationary rate is rising, and that we're no longer coming out of a global financial crisis. And if we can avoid another major financial crisis where we literally have to go back down to the zero boundary, we've got a lot of room to stimulate now without going back into the balance sheet. That's for now, and it looks like we'll have some cushion, and the descent on rates is going to be significantly slower and end up at a much higher level than we entered the situation at in 2020.
Matt, I want to pick up on what you were talking about with the funding program that the Fed has set up for the banks. How much are you seeing signs that there would be serious financial distress if the Fed were to wean the market from this backstop that they created after SVB?
Well, Lisa, I mean, banks, of course, have the ability to raise funding in other ways, but it's clear from the weekly take-up at this facility that there are certain institutions out there in the market that feel it's in their best interest to continue to tap this facility. We wouldn't expect the facility to go away in March, but it is something that we carefully monitor. And in addition, when you look at the amount of reserves in the banking system, they've been resisting falling from their current levels. And so in some ways, I think what the system is telling us is that the Fed may have already reached the minimum level of reserves that are required for these banks to continue to conduct their businesses. So we're kind of trying to monitor all of these various signs, and what we see does concern us, I have to say.
Matt Hornbach, we're going to have to finish that conversation another time. Diane Song, to both of you, thank you so much for taking the time on this Fed Day. And I've got to say, we have such an ace panel with us, Tom. The fact that we have such incredible names, Matt Hornbach, Diane Swank, Rich Clarida, who is sticking with us, and we are grateful for that. Joining us now to the conversation, Greg Peters, co-CIO at PGIM Fixed Income, and Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. And to that point, Greg, do you see things starting to break in the financial sphere that the Fed is kind of papering over with some of the programs that'll be key to watch?
No, I don't think so. I mean, I think those backstops are just that. They're backstops. I think there is this persistent worry around the proper function of the Treasury market. So regulators are vigilant around that, as is the Fed. So no, I don't think anything's breaking at this point. And if you just take the data on balance, it's actually reasonably good. So there's this whole sky is falling mentality out there. Preparing for a rainy day is important, of course, but as of right now, it's pretty bright and sunny.
Greg Peters, where's an appropriate inflation-adjusted rate? If I look at the 10-year real yield, 2.50 early this morning. I know you came in late today, Greg. Right now, 2.39%. We've seen a reduction there, but still way elevated over 2 years ago. Where's the appropriate real yield?
Yeah, so I mean, I think we've been so stuck in this central bank dominant world where everything was topsy-turvy upside down, where actually negative real yields was an inducement, right? And that was a far cry in how we thought about real yields in the past, right? Real yields are a function of, pretty strong growth, stable growth, and, a little inflation. So I think we're in a much more normal environment today. And quite frankly, Tom, I think we're so jaded by this recency bias when the Fed just dominated the game and pushed real yields to really kind of uncharacteristically low levels.
Kathy Jones with us of Charles Schwab, and her recency bias is clients going, should I buy a money market fund or an 8-year CD? Kathy Jones, I look at the moment that Greg Peters was just describing, and just simply all it comes down to me is, what do I do with 5% cash? What are you seeing at Schwab? What are people doing off of the Fed action with a money market fund, and I'm going to call it 5.5%?
Well, we're seeing, again, clients do lots of different things. So we have lots of different clients, but we are seeing a lot of interest in, say, CD ladders, Treasury bill ladders, Treasury bond ladders, as people look at where the yields are, and the real yields, which we've been pointing out have been pretty attractive. They're starting to sort of tiptoe out the curve. We don't have a lot of interest in going very long on the curve, but I think the idea of capturing 4, 5, 6%, depending on what instrument you're in, yields going over the next 5 to 7 years is looking more attractive. So we're starting to see a little bit of that action. A lot of laddered securities, though, is a way to kind of average into the market. But I do think the longer we can hold in some sort of a range and stabilize, and the more we can get a signal from the Fed that maybe there's not a lot more coming in the way of tightening, the more people will get up the courage to extend out a little bit in duration.
Kathy, I know that you're very interested in the balance sheet and hearing about what the Fed has has to say. And we did just hear from Matt Hornbach that he thinks that the Fed has hit the minimum amount required of reserves, that basically we're bumping up against the size maybe the balance sheet needs to be. Do you agree with that?
Yeah, I have only done a small amount of work on it, which is why I want to hear what the Fed has to say about it, because I'd like to know what their thoughts are. And we really haven't gotten them to talk about what's the optimal size. We've had some estimates of 20 to 25% of GDP. Now, if you do that, you're going back, we're going down quite a bit more, but that against where, reserve requirements should be. And, you're kind of at odds, which is why I find this question of the Fed continuing QT, even when they eventually shift to easier policy, I find that to be a big question mark in my mind as to how those two policies can kind of coexist smoothly. So I don't know that we're at the minimum level yet. I think there's some room to go from here, but I am concerned. I would like to know what a deeper thought process than the little information we've been given.
Rich Clarida, what's so important here, and I'm thinking of your conversations and your counsel to the portfolio managers at PIMCO. And in the moment we're in, there are select people out there saying bonds out in maturity are a screaming buy. How do you frame that at PIMCO, given what the Fed is doing post-pandemic? Can you say price up, yield down, and go out in maturities to get total return?
Well, that's exactly. In the sense that investors can earn returns that they would have been drooling over 3 years ago by not moving all that far out on the curve. Certainly, if you look at investment-grade corporate or mortgage-backed securities. So what we're saying is that there is a menu of opportunities available to investors, but when you can get returns, real rates where they are now, and because we're in the camp that thinks the Fed will succeed in ultimately bringing down inflation, that this is a great entry level, and you don't have to take a lot of duration risk. Some investors, because of their business model, do have more duration risk, but there are opportunities even if you don't want to add that.
This is great. The Dean of Columbia Economics is bond manager. I think Rich Clarida just got out a bond ticket and said, let's go long.
Which is the reason why he's currently at PIMCO, though I do want to just get a sense from you, Rich, about the balance sheet question, about whether the Fed's balance sheet needs to be a lot bigger than people previously had imagined, and if we're kind of bumping up against that level.
I don't think we're bumping up against that level, Lisa. Remember, the Fed has another acronym, the Reverse Repo Facility Program, that's got $1 trillion in it. That money, once it leaves that facility, will then flow back into reserves. So I think if you factor that in, I think there is more road for the Fed to travel to shrink its balance sheet. I agree with your previous guest. It is interesting that the Fed has talked about continuing QT even after they potentially adjust rates. When I was there in 2019, we stopped QT before we cut rates. So that would be an interesting difference.
Professor Clarida, thank you for your generous time today here at this Fed meeting. We're going to let Rich Clarida go here 6 minutes away from this important press conference. With us, Kathy Jones of Schwab and Greg Peters of PGIM. Greg, I'm just going to ask you a simple question here, and I'm starting to hear it a lot. Are bonds a screaming buy?
I think there's a tremendous amount of value in the bond market today, but I want to go back to, do you really want to extend duration? I think you do, but you want to do it very carefully. So I think the shape of the curve matters a lot. Tom, you keep talking about cash, and the shape of the curve tells you to be defensive, tells you to be in cash. So if you subscribe to this higher for longer front-end rate environment where the Fed can no longer kind of cut down to zero and has that flexibility, then you need to see the curve normalize before you really step in and moss out the curve. So to me, it's really quite simple. The shape of the curve dictates where you want to be on the curve. While there is value, absolutely, we're excited about it. I don't really see the need to rush out and lock in duration here.
Greg, it seems like a year ago, but we got the refunding announcement, from the Treasury Department earlier today, and it seemed to move the market quite a bit. Do you think that we learned today that supply right now is trumping any kind of fundamental economic read, that it really does come come down to simply there are not enough buyers to pick up the U.S. debt with yields as low as they had been traditionally?
No, absolutely not, Lisa. But I know you like to push that narrative. I don't think that's true. I think on the margin, yes, it does put more pressure on the back end, but it goes back to the shape of the curve. Why is the curve inverted when we're printing 5% GDP and inflation's around kind of 3%? So, I think that is really the fundamental dictate here, not so much the supply. At some point, it will matter. But I don't think that is the driver today. I think that's more of a kind of a politically driven red herring than anything else.
Kathy Jones, it'll be interesting to see how the chairman addresses commercial banking. We've been talking all day about the Keefe-Bruyette Index, BKX, really having some challenges technically. And, of course, finding a bid has been a challenge, even with the Dow up 100 points, NASDAQ up 0.8%, VIX 17.43. Kathy, the heart of the matter is the movement of money from deposits to money market funds, and that's the theory here of instability that could come. Do you see those potential instabilities out there in the trust market between deposits and money market funds?
Well, I think if there's any issue that the Fed is now very much focused on and has its arms around, it's this one. After what happened in March, I've got to believe that the regulators and everyone else at the Fed and indeed in the regulatory environment for banking in general is scrutinizing this pretty tightly. So I don't know that this is going to be some sort of a trigger for a crisis so much as something that's going to have to be worked out over time. And I think that it probably means a lot more mergers among financial institutions and recapitalization, et cetera. But it's usually not the things that everyone is focused on that bring up the crises. It's something that no one's watching.
I can't say enough about this, Lisa. Well, what we've done today and with the terrible construction of the Keefe-Bruyette Woods chart, it's simply got to come down to combinations and transactions. I just see no other way to do it.
Yeah, although we do see a lot of positivity in the underlying economy, and we see that with the JOLTS report out earlier today and a whole host of other components. Greg Peters really was talking about that. So, Kathy, from your vantage point, how much and when do we know that we are underestimating the strength of the economy and the sort of momentum behind this inflation?
Well, I think what you're getting at, Lisa, is this question of, what's the growth rate? What's the underlying growth rate going forward? What's R and R star and all those questions? I think that obviously a lot of debate around that. There is a strong belief that we've moved to a higher level of economic activity for a lot of reasons going forward than we've had over the past decade or two, and that means that we're at higher rates for longer, that the resting place is higher than it was before. So, how will we know? I think the labor market is probably the key indicator, right? If we start to see an acceleration in jobs and, real decline in the unemployment rate, that would be certainly a big surprise. I think expectations are it's going to go the other way since we've had so much tightening in the system. So it'd be a pretty big shock if we saw that component of the economic environment shift upward. I don't anticipate that will happen, but I think that would be the big surprise.
Kathy Jones and Greg Peters, both of you, thank you so much for being with us on the playoffs game equivalent in the economic sphere. Tom Keene, Jonathan Ferro, Lisa Bromwich, John off today for this Fed Decides. We're about 2 minutes, about a minute and 40 seconds away from the Fed press conference with Fed Chair Jay Powell. Yeah. And we could see a steady bid into markets pretty broadly on the wake of this belief that perhaps this is the last, we already saw the last rate hike by the Federal Reserve.
Yeah, it's up away a little bit, but these are titanic moves. And again, as I said, into the Fed, what's unique, folks, is you watch the screen and you watch the tone of the red and green, not even what the data is, but just the pulsing of the Bloomberg Professional Service. And the answer is it was way more vibrant into this meeting than I've seen in ages. You see it with a nice equity lift, 0.9% in the NASDAQ. Bonds have come back a little bit from a ginormous move, price up, yield down. And even currencies following up off early morning angst in Japan, signals strong dollar. I wonder if he's even going to address strong dollar. What I noticed is Michelle Smith got up on the podium there with the flags and, the podium ready to go and all that. And, she addresses the press and says, Mike McKee, you do get the last question. That's what she was saying.
Usually that's how it works. Maybe this time it will be different. Honestly, to me, the big takeaway here is that people are looking for a sense. The Fed has completed their effort to raise rates, and now they're going to be patient. That basically seems to be the message the market received. You see that in two-year yields coming sharply lower. Usually we have seen the two-year yield kind of be quiescent as we see the moves in the 10-year and the 30-year yields. At this point, some of the big question marks for Fed Chair Jay Powell as he approaches the podium is just simply how much can he really lean into hawkishness without having hiked at this meeting.
And I wonder about data dependency. I think we'll see it 14 times. He's going to be very data dependent.
And here we see him walking out. Do we have unanimity as well? Let's take a listen to Fed Chair Jerome Powell.
Good afternoon, everyone. Welcome. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a strong pace and well above earlier expectations. In the third quarter, real GDP is estimated to have risen an outsized annual rate of 4.9%, boosted by a surge in consumer spending. After picking up somewhat over the summer, activity in the housing sector has flattened out and remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 266,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.8%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years, and immigration has rebounded to pre-pandemic levels. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Total PCE prices rose 3.4% over the 12 months ending in September. Excluding the volatile food and energy categories, core PCE prices rose 3.7%. Inflation has moderated since the middle of last year, and readings over the summer were quite favorable. But a few months of good data are only the beginning of what it will take to build confidence that inflation is moving down sustainably toward our goal. The process of getting inflation sustainably down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we are confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Evidence of growth persistently above potential, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of monetary policy. Financial conditions have tightened significantly in recent months, driven by higher, longer-term bond yields, among other factors. Because persistent changes in financial conditions can have implications for the path of monetary policy, we monitor financial developments closely. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook and for economic activity and inflation, as well as the balance of risks. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below potential growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Let's go to Howard.
Howard Schneider with Reuters. Thank you, Chair Powell, for doing this. To what you referenced the rise in long-term bond yields, to what degree did that supplant action by the Fed at this meeting?
Thanks for your question. So, I'll talk about bond yields, but I want to take a second and just sort of set the broader context in which we're looking at that. So if you look at the situation, let's look at the economy first. Inflation has been coming down, but it's still running well above our 2% target. The labor market has been rebalancing, but it's still very tight by many measures. GDP growth has been strong, although many forecasters are forecasting, and they have been forecasting, that it will slow. As for the committee, we are committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to 2% over time. And we're not confident yet that we have achieved such a stance. So that is the broader context into which the strong economy and all the things I said, that's the context in which we're looking at this question of rates. So obviously we're monitoring, we're attentive to the increase in longer-term yields, and which have contributed to a tightening of broader financial conditions since the summer. As I mentioned, persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices, could matter for future rate decisions as long as two conditions are satisfied. The first is that the tighter conditions would need to be persistent, and that is something that remains to be seen. But that's critical. If things are fluctuating back and forth, that's not what we're looking for. With financial conditions, we're looking for persistent changes that are material. The second thing is that the longer-term rates that have moved up, they can't simply be a reflection of expected policy moves from us. That we would then, that if we didn't follow through on them, then the rates would come back down. So I would say on that, it does not appear that an expectation of higher near-term policy rates is causing the increase in longer-term rates. So in the meantime, though, perhaps the most important thing is that these higher Treasury yields are showing through to higher borrowing costs for households and businesses, and those higher costs are going to weigh on economic activity to the extent this tightening persists. And, the mind's eye goes to the 8%, near 8% mortgage rate, which could have, pretty significant effect on housing. So that's how I would answer your question.
Just as a quick follow-on to be clear on this, in your opening statement and just now, you seem to imply that you are not yet confident that financial conditions are restrictive enough to finish the fight. Is that true?
Yes, that's exactly right. To say it a different way, we haven't made any decisions about future meetings. We have not made a determination, and we're not. I will say that we're not confident at this time that we've reached such a stance. We're not confident that we haven't. We're not confident that we have, and that is the way we're going to be going into these future meetings, is to be just determining the extent of any additional further policy tightening that may be appropriate to return inflation to 2% over time.
Gina.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder, if you don't raise interest rates in December, would the presumption be that at that point that we should expect that rates are at their peak, or is there a possibility of restarting rate increases next year? And are there any costs to taking a more extended pause?
So let me start by saying we haven't made a decision about September. You're asking a hypothetical there, but we're going into the December meeting. We'll get, as you know, 2 more inflation readings, 2 more labor market readings, some data on economic activity. And so we'll be taking, and also the broader situation, the broader financial conditions situation, and the broader world situation. We'll be looking at all those things as we make a decision in December. We haven't made that decision. I would say, though, that the idea that the idea that you would be difficult to raise again after stopping for a meeting or two is just not right. I mean, the committee will always do what it thinks is appropriate at the time. And again, we haven't made any decisions at all about December. We didn't talk about making a decision in December today. Really, it was a decision for this meeting and understanding broader things.
Nick Timmeros of the Wall Street Journal. Chair Powell, did the Fed staff put a recession back into the baseline forecast in the materials for today's meeting? And how much does this tightening in financial conditions substitute for rate hikes if the tightening is persistent? You had said it was worth maybe a quarter point when we had the bank failures in the spring. What is it here on something that's presumably more straightforward and more familiar to simulate?
So I guess I don't want to answer your question about the recession, but the answer is no. I think I have to answer it since we did publicly say in the minutes. You'll know anyway in the minutes. The staff did not put our session back in. I mean, it would be hard to see how you would do that if you look at the activity we've seen recently, which is not really indicative of a recession in the near term. In terms of how to think about translation into rate hikes, I think it's just too early to be doing that. And the main reason is we just don't know how persistent this will be. You can see how volatile it is. Different kinds of news will affect the level of rates. And I think any kind of an estimate that was, precise would hang out there and have a great chance of looking wrong very quickly. So I think what we can say is that financial conditions have clearly tightened, and you can see that in the rates that consumers and households and businesses are paying now. And over time, that will have an effect. We just don't know how persistent it's going to be, and it's tough to try to translate that in a way that I'd be comfortable communicating into how many rate hikes that is.
If I could follow up, I guess what makes you confident that tighter financial conditions will slow above trend growth when 500 basis points of rate hikes, QT, and a minor banking crisis have not thus far?
Well, that's the way our policy works is, and sometimes it works with lags, of course, which can be long and variable. But ultimately, if you raise raise interest rates, you do see those effects, and you see those effects in the economy now. You see what's happening in the housing market. You're seeing that now. You'll see if you look at surveys of people, it's not a good time, they think, to buy durable goods of various kinds because rates are so high now. I mentioned again, we're getting reports from housing that the effects of this could be quite significant. But you're right. This has been a resilient economy, and it's, I think, been surprising in its resilience. And there are a number of possible reasons why that may be. Our job is to achieve maximum employment and price stability, and so we take the economy as it comes. It has been resilient, so we take it as it is.
Colby. Thank you. Colby Smith with the Financial Times. In terms of the thresholds that you've laid out of what could warrant further tightening, the additional evidence of persistently above trend growth or some kind of reversal in the recent easing of labor market tightness, that seems to suggest something more powerful than just one more quarter point rate hike would be necessary. And I'm just curious if that's how the committee sees it.
So we've identified those factors. Those are not meant to be the only factors or a specific test that we're going to be applying with some metrics behind it. Really, we're going to be looking at the broader picture and what's happening with our progress toward the 2% inflation goal. Is the labor market continuing to broadly cool off and achieve a better balance? We'll be looking at that. Growth, we look at growth insofar as it has implications for our two mandate goals. We look at that, and we look at broader financial conditions. So we'll be looking at all of those things as we reach a judgment, whether we need to further tighten policy. And if we do reach that judgment, then we will further tighten policy.
Okay, and just in terms of the tightening of financial conditions, if that is having some kind of offsetting effect in terms of the need to potentially, again, raise rates, what then is the potential impact on the trajectory of rate cuts? Could we see those maybe pulled forward or have to see more than what the September SEP indicated?
So the fact is the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts. We're still very focused on the first question, which is, have we achieved a stance of monetary policy that's sufficiently restrictive to bring inflation down to 2% over time, sustainably? That is the question we're focusing on. The next question, as you know, will be, for how long will we remain restrictive? Will policy remain restrictive? And what we said there is that we'll keep policy restrictive until we're confident that inflation is on a sustainable path down to 2%. That'll be the next question. But honestly, right now, we're really tightly focused on the first question. The question of rates cuts just doesn't come up because I think it's so important to get that first question, as close to right as you can.
Steve Leisman, CNBC. Mr. Chairman, I guess I had assumed that there was a tightening bias in the committee. You say in the statement you're looking to assess the appropriate stance of monetary policy, the extent to which you may need to hike additionally. You didn't say earlier that you were sufficiently restrictive. There were forecasts for 2 rate hikes among most members of the committee. But then you just said that, we haven't made a determination. Would you say the bias right now is neutral, that there is no disposition to hike again, and that the committee largely has moved off of this forecast for 2 hikes? Or for one additional hike?
I think you're talking about one additional.
Yeah.
No, I wouldn't say that at all. I would say, the language, looking at it here, in determining the extent of additional policy firming that may be appropriate to return inflation 2% over time, that's the question we're asking.
So is it right to think of that as a hiking bias is still in the committee here?
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, you know, and that is the question. And you're right that in September we wrote down one additional rate hike, but, you know, we'll write down another forecast, as you know, in December.
Chris.
Thank you. Chris Rugaber at Associated Press. Well, since the last meeting, the auto workers' strike has finished. Oil prices have leveled off. And yet, on the other hand, you have the outbreak of war between Israel and Hamas. How do you see all those factors taken together affecting the economy going forward? How are you thinking about those?
So there are significant issues out there. As you point out, global geopolitical tensions are certainly elevated, and that goes for the war in Ukraine. It goes for the war between Israel and Hamas. We're monitoring that. Our job is to monitor those things for their economic implications. So the UAW strike, as you point out, appears to be coming to an end. Oil prices have flattened out. They haven't gone down, but I guess they've gone down a little bit from their earlier peak. Another one is the possibility of government shutdown. We don't know about that one. So there's plenty of risk out there. But I would go back to the bigger picture from our standpoint is we've got a very strong economy, strong labor market, making progress on the labor market, making progress on inflation, and we're very focused on getting confident that we have achieved a stance of monetary policy that is sufficiently restrictive. That's really our focus.
Great. And just one quick thing. You last month had gone to York, Pennsylvania, where you talked to last month, where you talked to a lot of small business owners. Just curious, what sentiments did you hear from them, or what did you picked up on, and was there anything that surprised you the most in terms of what they talked about?
I wouldn't say I was terribly surprised. I was very impressed by York as a town with a real strategy, and I would say it's very impressive what the people there have put together in the face of some difficult longer run trends about offshoring of manufacturing and that kind of thing. They've done a great job as a city, I think. What you hear, and is consistent there, which is people are really suffering under high inflation. You were there. We talked to some people who, were feeling that in their businesses, and other people who were feeling it in their home lives as well. It's painful for people, particularly people who don't have a lot of extra financial resources, who are spending most of their income on the essentials of life. So we know that wasn't new, but that did come through very clearly in the conversations we had in New York. And I walked away from that even, just thinking that we really the best thing we can do for the U.S. is to restore price stability. Fully restore price stability and not fail in that task, and do it as quickly as possible, but also with the least damage we can.
Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You've spoken before about the pain that would likely be coming for the economy in order to get inflation down. But since the economy has not responded to rate hikes in ways that would normally be expected, have you changed your views on that at all, on how necessary or inevitable that kind of pain would be, say, for the labor market or overall growth?
Well, I think everyone has been very gratified to see that we've been able to achieve, pretty significant progress on inflation without seeing the kind of increase in unemployment that has been very typical of rate hiking cycles like this one. So that's a historically unusual and very welcome result. And the same is true of growth. We've been saying that we need to see below potential growth, and growth has been strong, but yet we're still seeing this. I still believe, and my colleagues, for the most part, I think still believe, that it is likely to be true. It is still likely to be true, not a certainty, but likely that we will need to see some slower growth and some softening in the labor market conditions to get to fully restore price stability. So, but it's only a good thing that we haven't seen, and I think we know why. Since we lifted off, we have understood that there are really two processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower growth. It's supply side improvements like shortages and bottlenecks and that kind of thing going away. It's getting a significant increase in the size of the labor market now, both from labor force participation and from immigration. That's a big supply side gain that is really helping the economy, and it's part of why GDP is so high, is because we're getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left, we think, and I think, we'll still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out. But it's going to come due and have to get rolled over next year or the year after. So and there are little things like that where the effects are just taking time to get into the economy. So I think we have to make monetary policy under great uncertainty about how long the lags are. I think trying to get a clear answer and say, oh, I'm just going to assume this is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy. And it takes time, we know that, and you can't rush it. So slowing down is giving us, I think, a better sense of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plot's out the window, that every meeting is live with the possibility of a rate increase for right now. Doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment meeting by meeting.
Well, so let's talk about the dot plot first. So the dot plot is a picture in time of what the people on the committee thinks is likely to be appropriate monetary policy in light of their own personal economic forecast. In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change, for example. I mean, many things could change that would cause people to say, I wouldn't write down that dot, 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period between that meeting and the next meeting. But nonetheless, it's out there, and we do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things. We're laying out there our thinking, and as we approach the meeting, we'll all be, my colleagues and I will be talking about how we're processing that data. In terms of, we're not really changing the way, in terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily, potential growth is elevated for a year or two right now over its trend level. So the right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration, and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential. And that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about the meeting by meeting, are we essentially now supposed to assume that it's a meeting by meeting, live meeting with a chance of a rate increase that will be decided on subjective criteria rather than objective at each meeting?
I don't know that I want to just accept anybody's characterization of it. I'll tell you how we're doing this. So we're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far. And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression a belief as of September. It's not a promise or a plan of the future. And so we're going into these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly in interest-sensitive spending and other channels. So that's how I think about it.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be a reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So, committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up, and QT is certainly on that list. It may be playing a relatively small effect, although I would say at $3.3 trillion in reserves, it's not. I think it's hard to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask about the Basel III endgame capital proposal. You've gotten a lot of pushback from people on different aspects of the proposal, and you yourself expressed some reservations. And I'm just curious, could you accept finalizing that proposal without significant changes?
So that proposal is out for comment, and we expect a lot of comment. We won't get those comments until the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to, we're a consensus-driven organization, we'll come to a package that has broad support on the board.
So does broad support mean more support than the proposal had?
It means broad support.
Janelle Marte with Bloomberg. So in addition to persistence, when you look at long-term Treasury yields, what else are you watching to evaluate how those tighter financial conditions are hitting the economy and if it will lessen the need for further tightening? Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich environment, and we tend to look at a few of them. I'm not going to give you the names, but there are a few of the common ones that people look at, and so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads. Sometimes they're pulling in credit availability and things like that. So it isn't any one thing. We would never look at, for example, long-term Treasury rates in isolation nor will we ignore them, but we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your second question was
on the banking stress.
Banking stress. So it's something we're watching. As you know, we did have there were issues with interest rate risk and also funding uninsured deposits in the things we went through in March and thereafter. And so we've been working a lot with financial institutions to make sure that they have good funding plans and that they have a plan for how to deal with the kind of portfolio unrealized losses that they have. We do think the banking system is quite resilient. We had a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors on liquidity, on funding, and those sorts of things.
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your colleagues put forward a proposal to lower the cap on debit card swipe fees for comment. Could you just talk a little about the considerations there, what it would mean for merchants, for banks, for consumers, and also just what y'all are seeing in terms of the use of both debit and credit cards in the payment system?
So you're right. We put a proposal out for comment is what we did. And, this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is faithfully implement the statute. That's all we're trying to do. What else can we really do? It's a 90-day comment period. We typically don't comment on these things once they're out for comment, and we do hope that stakeholders, and we know that they will use this opportunity to express their views. They haven't been shy about that. So that's critical, and that's what I can say about that now.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long would you be okay then with a 3% or 3% plus overall inflation?
The progress is probably going to come in lumps and be bumpy, but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically, that's sort of consistent with the way inflation comes down. It does take some time, and as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
Well, you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Rabinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the Bank Term Funding Program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in one-year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the UM thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary but that didn't get picked up. So we look at many things, and so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I was curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, but ultimately we've got to look at the effects that policy is having, accounting for the lags, which makes it difficult.
If I could follow up on a wages point earlier, you talked about the inflation outlook, but I'm curious if you have any concerns whether wage inflation at its current level could risk pushing up overall inflation or reacceleration.
So if you look at the broad range of wages, they have wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. And you have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back a couple, comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally, too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver of inflation so far. Although I do think it's fair to say that as we go forward, as monetary policy becomes more important relative to the supply side issues I talked about and the unwinding of the pandemic effects, it may be that the labor market becomes more important over time too.
Nancy. Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, are you now as concerned about overshooting and raising interest rates too much as you are about getting inflation down to the 2% target?
So as I mentioned, I think for much of the last year and a half, the concern was not doing too much, not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is clearly restrictive at 5.25% to 5.5%. That range. If you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really. What the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling and coming down? Now, we've seen periods like that before, and there hasn't been follow-through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think that's what we want to see, that whole set of processes continue.
Brian Mena, CNN. Do you think that has been any structural change in either consumption or in the job market that's pushing up consumption? You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And, there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation with now wages that are higher than inflation in the aggregate anyway. And that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had a really, that whole dynamic has been, and also at the same time, the pandemic effects are wearing off so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and there's more labor supply. So the whole thing has led to more growth, more spending, and that kind of thing. And it's been good. And the thing is, we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue? And I just think the existence of this second set of factors at this time, which is the unwinding of the pandemic effects, that's what makes this cycle unique, I think. And we're still learning. That took longer for that process to begin than we thought, and we're still learning about how it plays out. That's all we can do.
So to Daniel, for the last question.
Thank you, Chair Powell. Daniel Avis from Agence France Presse. Just a quick question following up on an earlier one. With regards to the Israel-Hamas conflict, the Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. You've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring these developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say, so, really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and the economic effects. And it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take really important notice of, but it may or may not turn out to be something that matters for the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. The war in Ukraine, did have immediately very significant macroeconomic implications because of the connection to commodities. So, thank you.
Thank you.
Thanks very much.
That was Fed Chair Jay Powell speaking for almost an hour, for 50 minutes. This is the Fed Decides on Bloomberg Television, on Bloomberg Radio. Tom Keene, Jonathan Farrell, Lisa Abram-Westjohn off today. And really, I've got to just go straight to the markets. What the Fed said is we don't have any decisions about any further rate hikes. What the market heard is, you're done. And you can see a rally in bonds. You're seeing a rally in stocks extending to session highs on the S&P, up more than 1%. The NASDAQ gains of 1.6%. The two-year yield firmly below 5%, Tom. That caught my attention at a time when the Fed is trying to parse through nuance and the market only hears one thing.
The moves are so correlated and so abrupt, including oil, West Texas Intermediate almost getting down to a 79 handle, which the chairman alluded to in the final question on the war in the Eastern Mediterranean. But in the bond market, Lisa, what's so important here is these moves are so large, I have to go to a standard deviation analysis. Conventional financial TV doesn't capture the magnitude of the vote you're seeing. David Rosenberg, always brilliant out of Toronto, making clear this is a Fed that is done, and yet the singular point was Leisman of CNBC and McKee of Bloomberg, where he stopped in the middle of his conversation to say we stand stand ready to be hawkish against this entire arc of we're done.
Q, whether or not they've lost some credibility, because he could say, we're prepared to hike again. We've made no decisions. We're going to have a consensus on the Federal Reserve. The market, again, really is starting to price out further rate hikes more materially. I will just say this. In terms of whether the market is doing the work for them, he speculated that it was really persistent changes in financial conditions, and it's too soon to say. Everything was hedged. Everything was going back to the notes. Everything was very rote. He did as much as he could to say as little as possible.
Yeah, I'll go with that. And I like the idea that everything was hedged in the sense of we didn't hear data dependency much, which surprised me. I thought we'd say, okay, the jobs report, maybe we finally see a crack in an economy coming off 4.x% real GDP. I think that this was taken by the markets, which is really what I would focus on. The Dow up 250 points, 1.6% move. NASDAQ at 117 basis points of soft landing in the 10-year yield. The market is speaking volumes. They loved what they heard.
And this is going to, of course, be due to revision with time. And we've known that the knee-jerk reaction is not always the one that sticks. But, Tom, to me, the fact that the market is jumping on this, and that earlier in the day you saw yields tick lower because of their funding announcement, then even lower, particularly on the long end after economic data that came in weaker than expected, and then Chair Powell coming in and pushing them that much further lower as people expect him to be done.
Yeah, it's going to be interesting to see, to say the least. We'll continue to monitor the markets, and we have a stellar group of people to drive the conversation forward. Let's drive the conversation forward right now, almost quoting off Star Wars. He was very far away. A question from Michael McKee. Let us listen to the chairman here on what is out there.
We're going meeting by meeting. We're asking ourselves whether we've achieved a stance of policy that is sufficiently restrictive to bring inflation down to 2% over time. That's the question we're asking. We're looking at the full range of economic data, including financial conditions and all of those things that we look at. And then we've come very far with this rate hiking cycle, very far.
Who nailed this, the very far of it, was William Dudley, out of Berkeley for years, of course, at Goldman Sachs, and the former New York Federal Reserve president. Huge value at Bloomberg Economics and a senior advisor in economics for all of Bloomberg. Bill Dudley, you and I were in the lofty, cool climes of Marrakesh a few weeks ago as the international community confronted a unique American experiment, a dynamic fiscal inducement, a fiscal stimulus to where we are now. Your essay in the last 2 hours for Bloomberg makes clear you have immense concern that the Fed, given the cards dealt, could get this wrong. What did the chairman not address in this press conference?
I think that he's quite confident that policy is restrictive enough to slow the economy down. And I think the fact that we just had a growth quarter of nearly 5% calls that a bit into question. Also, the notion that financial conditions are truly tight enough to slow the economy down, I think is also pretty questionable, because if you look at most financial condition indexes, the biggest impulse towards restraint really happened last year, not right now. So I think that maybe they have done enough, maybe they haven't. But I think the reason why markets are hearing this so confidently is he feels very confident the Fed has done a lot. He feels policy is restrictive, and so I think the market's taking away the notion that he thinks he's done. And obviously, that depends on how the economy evolves, what happens to inflation, what happens to the labor market. And the other thing that the market's taking a lot of a positive signal from is he talked about how all these pandemic effects are washing out now in a good way. So the labor market is becoming much more in balance. Labor force growth has picked up. It's a very benign story about how this is all played out. It's basically a story where the Fed really hasn't had to do that much to bring inflation down, and the Fed basically is saying, we don't think we're going to have to do much more from here.
Chair Powell also didn't seem to think that there was any casualty in pausing, letting time go on, and then restarting rate hikes. He said that wasn't problematic at all. Do you disagree?
Obviously, if it turns out that they need to do more, they're probably going to have to do more than just 1/4 point move. If you've taken a break for, let's say, 6 months, and the evidence accumulates that monetary policy is not as tight as you think it is, and inflation expectations are starting to become unanchored, labor market's not loosening, wages are stuck at 4.5%, then it's unlikely that 1/4 point move is going to be sufficient to do the job. So I think it's either 0 or multiple rate hikes.
Which is a reason why I probably some people are looking at this like yourself and saying they could be on the brink of an error. There was a question about how financial conditions really played into the Fed's decision, whether higher yields were doing their work. He had some nuance around this, talking about a sustained move higher. Take a listen to Chair Powell speaking on the issue.
Persistent changes in broader financial conditions can have implications for the path of monetary policy. In this case, the tighter financial conditions we're seeing from higher long-term rates, but also from other sources like the stronger dollar and lower equity prices could matter for future rate decisions. With financial conditions, we're looking for persistent changes that are material.
Bill Dudley, from your vantage point, does this give any clarity as to how the Fed is counting yields in their picture of what restrictive really looks like?
Well, I think I agree with him that persistence is what matters. I mean, if bond yields go up for a week or two and then come right back down, that's not going to exert much restraint on the economy. One problem I think the chairman has at this point is by talking to the markets in a sort of supportive way, stocks rally, bond yields fall. That's loosening financial conditions, and so that's removing some of the restraint that was creating some impetus for not tightening monetary policy further.
The heart of the matter to me, Bill, and I don't want to turn this into a Dale Jorgensen's 3 ratio course, and Julia Coronado's been brilliant on this as well. So let's listen to Dr. Coronado and Dr. Dudley, folks. And Bill Dudley said, barring unexpectedly fast productivity growth, there seems to be almost a hope and prayer, Bill Dudley, that this time is different and instantly we have a new elevated productivity. Do you see any signal of this in post-pandemic America?
I think it's really too soon to make any decisions about productivity at all. Productivity growth took a real hit during the pandemic, and then it picked up as we reopened. What the trend is at this point is very, very uncertain. And you notice that Chair Powell did not talk about productivity growth as that trend changing. What he talked about was the labor force growth had picked up a lot because labor force participation among adult workers has climbed a lot, and immigration had picked up. So he saw that as a positive supply side surprise, but I don't think that the Fed or I, for that matter, think that there's a productivity growth miracle right around the corner.
Bill Dudley, it's Wednesday. We're going to a jobs report on Friday. Let's go back to Dudley and McKelvey at Goldman Sachs a few years ago. What's an appropriate non-farm payroll statistic? Not on Friday, but say 3-month moving average out, where you can say all clear and finally we have a labor economy settling down. Is it sub 100,000?
Yeah, it's probably in that ballpark. I mean, as Chair Powell said, we are getting a surge in labor force this year, but I think he also expects that will peter out over time. And then you're just stuck with the growth rate of the working age population, which is probably only growing at about 0.5% a year. And so that's consistent with payroll gains of maybe 100,000 a month or even a little bit less. So I think that eventually the Fed needs to bring payroll growth below 100,000 if they're going to generate enough slack in the labor market to bring wage inflation down to levels consistent with 2% inflation.
Given the volatility that we've seen in the bond market, Bill, how concerned are you about a real blowback on Friday should we get a jobs report that comes in materially hotter than expected and we continue to see those upside surprises that you say may pose the biggest risk?
Well, I personally would not put too much attention on any one given economic release at this point because the Fed has basically said we are patient now. And so one economic report is not going to change their thinking. It's only an accumulation of evidence that suggests that policy is not sufficiently restrictive to do the job, which will cause the Fed to start to tighten monetary policy again. So I think we need to maybe downplay any single report at this point. It's going to take an accumulation of evidence for the Fed to decide that they need to do more on monetary policy.
Bill Dudley, thank you so much. Greatly, greatly appreciated this morning, folks. I'll send out the essay across all my social here. His op-ed is really must read. Some really good writing just in the last 24 hours from a number of people within the zeitgeist. I need to do a market check here because this is an historic move. I'm going to be as quick as I can, Lisa, as you go to Michael McKee. The Dow up 258 points, heading towards a 1% lift. I got a 1% lift. S&P 500 up a solid 47 points. NASDAQ 100 on fire, up 1.7%. That into Apple earnings tomorrow. Lisa, I should point out, 10-year yield, 18 basis points, modest move as well. And the real yield, Lisa, craters 2.50% after my first glass of Tang this morning. And we are down 16 basis points on the inflation-adjusted yield. The operative word, folks, is never. I don't think I've ever seen that.
It has been a pretty significant move and continues to be as the session grows older. Let's check back in with our own Michael McKee, who is in the room in Washington, D.C. Mike, do you think the Fed would be disappointed to see the market's reaction to Fed Chair Jay Powell's press conference?
Not disappointed in that sense. Clearly, if we continue to see this kind of drop in yields, it's going to take some of that market pressure off of the economy, and the Fed sort of goes backwards a little bit. But I don't think they are counting on the markets being tight for a long time to completely do their job for them, because as you mentioned just a moment ago, if you get a blowout number on Friday, then everybody's going to reverse. I think the takeaway here is that the Fed would like to be done, or at least at peak, and switch to the idea of how long, but they can't be sure yet. And I think the analogy I would use is the Fed chairman is Potter Stewart at this point, the former Supreme Court justice who said that he could not define pornography, but he knew it when he sees it. At this point, the Fed can't define what sufficiently tight is, but meeting by meeting, they will decide what they see. So you kind of throw out the dot plot, which is what I was getting at with my question to him. The markets can't predict anymore what the Fed is going to do. They have to go into every meeting trying to assess what the Fed will think about conditions at the time, rather than some sort of objective data release.
So Mike McKee, in your tenure, back to Arthur Burns, you were a young buck there with Arthur Burns a few years ago. Have you ever seen a Fed working away from theory, away from the orthodox? They seem to be literally, as you and Steve Leisman alluded to, making it up meeting to meeting.
Yeah, I mean, orthodoxy changes, obviously, and the time from Burns to Greenspan, it changed quite a bit, and it's still a Fed truism that the inflation is kind of the key to everything, but they don't know what's going on. The models don't work or haven't worked coming out of the pandemic. It's all something new, so they are doing their best to try to figure out what's going on without using some of the history-based models and previous outcomes that they would have had to use in the past. And this will engender a lot of rewrites of monetary policy thinking, I'm sure, going down the road.
Just to sum this all up, is strategically patient the new sufficiently restrictive?
I saw that comment, and I think it is it sums it up pretty well. They are going to be patient. They're going to have a good reason to do whatever, whether it's cutting rates, raising rates. They will not have to have a good reason to just leave rates where they are. They can just go with the economy as they see it.
Michael McKee, thank you, and wonderful question as always. Strategically patient.
Were you strategically patient last night at 9 p.m.
Absolutely
with the
not. No, I was not. Absolutely, with the sugar highs, et cetera. But this, to me, really highlights what they're saying. And then you put the stock chart and you put the bond chart next to it, and you hear what the bond market is hearing. Just want to point this out. Two-year yields, 4.93%, getting close to crossing that threshold into the 4.92. Well, now it's bouncing around, but just highlights what a massive move we've seen on the front end.
Massive is defined by the pros, folks, and we welcome all of you not part of global Wall Street. People look at this this strange phrase, standard deviation. And all you need to know is you look back 20 days, 40 days, whatever, 20 weeks, and you try to figure out how much have we moved off the center trend. Jeffrey Rosenberg of BlackRock knows we've seen a standard deviation move. He is with their systematic multi-strategy fund. Oh, I can see you in the classroom as a freshman at Carnegie Mellon, Jeff Rosenberg, going, what in God's name is standard deviation? Did we get a jump condition today, Jeff Rosenberg, towards a less restrictive Fed?
Well, as Lisa pointed out earlier, there's a lot of data coming out today, and so parsing out the reaction from the Fed versus the earlier, kind of main event behind the Treasury refunding is a little bit tricky. But I would highlight that the main kind of differentiation is really the reaction in the front end of the curve, right? From the refunding announcement, that was really the back end, as Lisa highlighted, a little bit of the weaker data on PMIs also helping the back end rally. But the Fed market reaction was really in the front end. So I think Powell, you want to look at the statement and you want to look at the opening to the press conference. That's what they intended to say versus what the market interpreted from the Q&A. What they intended to say was to try to be balanced. Resiliency on economic growth implies we need to stay tight, maybe do one more against the tightening of financial conditions, which implies maybe we've done enough. That's what they were hoping to say. Clearly what the market saw was a preference for the worry of tightening financial conditions. We're at sufficiently restrictive, we can be done, and so you price out the little bit of probability for the next hike. That's the market reaction. As you went over in the earlier segment with Dudley, it remains to be seen. The data will dictate that. But certainly, to your question, Tom, big reaction. I think a lot more of that standard deviation move has to do with refunding earlier, a little bit coming out of this press conference.
Well, how do you play this then, Jeff? If you think that the market is reading way too much into what Jay Powell said, which was trying to stick close to the script, although perhaps giving a different tone than people thought of, do you then sell to your notes and wait for yields to go back up, for them to cheapen and buy them back?
Well, I think it's less a question about selling the two-year note now. I think given the pricing and given the data that we have that Powell referred to, 2 more inflation prints, 2 more labor prints, and what Dudley was just hinting at, are we really seeing the degree of tightness, the degree of sufficiently restrictive, given the trajectory of growth that we just came off of? Obviously, no one expects that to persist, but the risk there is that you're not pricing enough of the possibility of another hike, and so maybe you hold off on adding twos at these levels.
Jeff, from where you sit at BlackRock, and I understand there's an index play here, but there's some active management, and you're watching everybody else in the game. What's the bet of the market right now? Is the bet that we're going to get this Fed done in a more dovish, less restrictive tone, or is a bet, hey, we're scared stiff and we may move higher?
Well, I mean, you have a couple of different cross currents on there. Obviously, there's been a lot of talk about movement into the long end, movement of retail flows, buying the long end. That's very much kind of we're at or close to the end, and we're going back to the old playbook that once the Fed is done tightening, then you get a big rally. I think you got to be a little bit cautious about we're just simply going back to the old playbook, but certainly. There's a degree of that in the market. And then the other really big kind of consensus story is around the steepness of the curve, that the curve is just way too inverted, that you need to see normalization of the curve, all the factors around that. The refunding was a little bit of that kicked in post the August refunding announcement. Japan and the news on the BOJ and yield curve control, deficit financing. There's a litany of lists, but there's a very popular positioning around the steepening. And I think the reaction to the refunding earlier today really reflects that very crowded steepening position that exacerbates that standard deviation move that we saw earlier today.
Jeff, I want to go full circle to where Lisa and I were early this morning. Folks, we've been live since 2 a.m. this morning. It's really, quite something. And Jeff, it's about the commercial banking system of America, which the chairman alluded to maybe a little bit and maybe not enough for my taste. Can we get a bond market that heals to take those bond losses and drift them away into 2025, where things can even get better if we don't get a massive bond move, but just enough of a bond move? Is that really the strategy here?
No, and you did hear that question. It was probably one of the few questions on that topic. I mean, this is a historic move in terms of interest rates. So, even if you get a modest kind of cut in interest rates that the bond market in the second half of 2024 is anticipating, that's nowhere near enough to kind of unwind the unrealized losses that you're talking about from this historic move from 0 to 5. So that's really about a long-term story of repairing capital and dealing with those issues within the banking system. That if you kind of repair the funding concerns, and that was what the bank term funding question was referring to, then maybe that doesn't become a crisis moment, but it still becomes kind of a longer-term drag in terms of capital repair. That even a small rally as is anticipated in the bond market pricing for 2024 isn't going to be sufficient to repair.
Jeff, you talked about positioning, and I want to go there because a lot of people are saying short squeeze. This is a positioning squeeze, and we've been hearing that a lot.
Yes.
How much is levered funds that have come into the Treasury market, how much is that what's underpinning some of the incredible volatility that we've seen over recent weeks?
Well, that's a tough one to sort of pin it on leverage. There's a lot of drivers to that volatility and to that uncertainty. Positioning and crowded positioning exacerbates those moves, and that can be levered, it can be unlevered, it can be just asset managers who favor particular positions.
I don't mean to interrupt,
Sorry,
Jeff, but there's a difference between real money investors who are making a long-term bet on treasuries and people who are fast positioning, trying to make a trade. Or is the market right now being determined by the trading types, not by the real money?
I mean, in short-term reactions, absolutely, right? Leverage is going to exacerbate reactions to price movements. So I think it's really about, decoupling, and you said it earlier, the near-term reaction isn't always to any data point, whether we're talking about the press conference or on Friday to payroll or CPI. That near-term move, yes, that's going to be dictated by algos. It's going to be dictated soon by AI. It's going to be dictated by the levered positions and crowded positioning. But let's separate that from kind of the longer run impact of the fundamental signaling. And as you mentioned earlier, you can have the near-term reaction, and then a day later or 2 days later, it's a very different trend as we parse the totality of the data. But certainly, very short-term price reactions are going to be driven by those levered factors.
Jeff Rosenberg, thank you so much, as always, for your comments on this incredibly important day. It was supposed to be a snooze fest. It was not. Absolutely, certainly by the reaction. Into it wasn't either, because of the refunding announcement as well as some of the economic data. But really what we are seeing is a market coalescing around the idea, for now, that the Fed is done with rate hikes for this cycle.
And this is completely outside left field, but I guess it's stay tuned for Bloomberg in Asia and what Yvonne Mann will lead with at 6, 7, 8 p.m. as well. If you get a market like this in the West, if you get this joy to the world, is this the moment where the Bank of Japan can slide in and do something constructively about their busted theory? A little editorial idea.
Well, blink.
I'm sorry, folks. I had to go there.
Well, blink if you miss it. That's basically it. We do have wonderful guests coming up on the close. We get more reaction to the Fed decision. Guests including Charles Schwab, Co-Chief Investment Strategist Liz Ann Saunders, former Fed Governor Betsy Duke, and Princeton University Professor of Economics Alan Blinder.
It's going to be interesting to see. We will be with you tomorrow. Bloomberg surveillance, Apple earnings tomorrow, and then on to Jobs Day. It's been The Fed Decides. Good afternoon.
And it is now 3:46 on Wall Street. We do check the markets for you all day long here at Bloomberg. Has the Fed decided stocks are higher? I think so. Stocks surging after the Fed keeps interest rates steady, holding those rates at a 22-year high with no hike. And Fed Chair Jay Powell saying the Fed will proceed cautiously. You might, though, say the dot plot thickens because reporters asked Fed Chair Jay Powell if it's fair to say the Fed is backing away from the tightening bias and toward 2 more rate hikes in this cycle. Here's what Powell had to say about that.
We haven't used that term, but it's fair to say that's the question we're asking is, should we hike more? It's not, and that is the question. And you're right that in September we wrote down 1 additional rate hike, but, we'll write down another forecast, as you know, in December.
And that's Fed Chair Jay Powell commenting to reporters there. Powell did also say financial and credit conditions have tightened significantly. He added the word financial to that phrase, something that is raising an eyebrow for Richard Clarida, Global Economic Advisor at PIMCO.
The challenge with putting the financial conditions term in this statement is, financial conditions can go up and down and be volatile for a lot of reasons. And then at some point, they may regret that they included it in the first place.
Yeah, and that's Clarida with us there on our special program, The Fed Decides. The Dow right now, as we head to the close, it's up about 0.7%. Big jump for stocks, as Powell spoke, up 237 points right now. The S&P 500 up more than 1.1%, up about 47 points. And the NASDAQ, it's up 1.6%, up 210 points. The yield on the 10-year, lower right now, 4.75%. Spot gold, it is lower as well. 1978 an ounce. Crude oil was higher earlier in the day. Now crude oil is lower as well, down 0.2%. And shares of Six Flags and Cedar Fair, they both rose on a report. The two theme park operators are in talks to merge their business. Wall Street Journal says a deal could be announced as early as this week. And that is your Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
And a very good afternoon, everybody. Welcome to Bloomberg Business Week, live in our Bloomberg Interactive Broker Studio, streaming on YouTube and Bloomberg Originals. It is a Fed Wednesday, as you've been listening on radio, TV, and across Bloomberg channels. A Fed Wednesday, the first day of November, and the Fed holding rates at a 22-year high for a second straight meeting. And the Fed Chief, Jay Powell, asking, should we be hiking more, which I feel like sets the tone. I'm Carol Massar. Tim Stanovec is off today, and with us is Bloomberg's Mike Regan. And I do feel like, Mike, there was a lot of things where he kind of continued to remind us that inflation is still elevated, and I feel like they might not be done yet.
Yeah, I mean, and I don't think he said anything too new today or really changed the outlook for interest rates at all, but we do have this really wild rally in the stock and the bond market right now. So I wonder, how much of that is sort of people caught on the short end, short selling both stocks and bonds before this, and now having to cover. Yeah, I'm not 100% convinced you can trust this as sort of the market's interpretation of what he said.
Right? Like you think about how they were positioning ahead of all of this and thinking it was going to be a lot more negative.
Yeah, and so often, we see these reactions in the market the day of a Fed press conference, and then wake up the next morning and wait a minute, everyone decided to go.
24-hour cycle? That hasn't happened before this year. It's a really good point, but we are seeing equities hold, and it's pretty broad-based buying. We're going to talk markets in just a moment. Also ahead, how hedge funds are turbocharging volatility in cratering U.S. bond markets. I mean, it's been quite a year, Mike, for bond markets.
I know. Talk about the market that was so sleepy, people forgot about it. It was the most boring market in the world, but really wild volatility, a lot of different sort of trading strategies among hedge funds coming in to profit off of that volatility. And, there's a little bit of a backlash to that. Government wants to investigate some of these strategies, so it's getting interesting.
I love the story. It's in Bloomberg Business Week, the new issue coming out. We've also going to get a check on the economy, the farming economy. The AGCO CEO is going to be here on what's driving their upbeat profit forecast. And then we've got how in deep red Donald Trump country, voters are loving President Biden's green jobs. I feel like, Mike, we're living in this world where it's kind of these, what I always call, wait, what moments? Like, help me understand?
Yeah, exactly. Alabama, especially, first solar plant going there. And really, it makes you wonder how much people think about the politics behind the initiatives that caused this job creation down there. So it'll be interesting to hear what the reporter on that story has to say.
I can't wait to hear what the CEO of Pernod Ricard North America has to say about demand, consumer trends, what kind of things people are drinking and how they're expanding their portfolio? Screwball whiskey?
Screwball, yeah. We're going to dive deep into Screwball whiskey. I wish we should have really be sampling it before this interview, I think.
It's not
That
Friday yet,
might go
but
off the
why
rails a little bit.
And we've got the Skim co-founder, Danielle Weisberg, back with us. She's going to talk about, I want to talk about subscribers of business, but also topics that resonate with their base. Let's get back to the markets. It is a Fed Wednesday. Stocks are rallying. We've seen yields back off. And lucky for us, on our drive to the close on this Fed Wednesday is Amanda Agati. She's Chief Investment Officer at PNC Asset Management, joining us once again out there on Zoom in Philadelphia. Amanda, there's a rally underway in stocks. Yields have backed off. I think Mike makes a great point that maybe some investors were caught off guard expecting a much more negative tone or negative description, statement, whatever, from the Federal Reserve. Do you discount the trade today?
Oh, absolutely. I discount the trade. I mean, there's no question that sentiment has been pretty lousy the last, 4 to 6 weeks. Yields have moved rapidly higher. We think very crowded positioning at one end. So there's a scurrying around that's happening here into the close today to reposition. But I'm not sure that we learned a lot of new information. I mean, I think it's hard for me to say that Powell had his hawk costume on for Halloween, and maybe it was a little bit lighter of a tone than he has been recently, but the door is still very much open for additional tighter policy from here. So we think this rally is going to be short-lived.
Amanda, I know you're in Philadelphia, and I think we should make a deal not to discuss the Phillies at all during this interview.
Thank you.
If you're
I
okay with
appreciate that.
Yeah, me too. But I wonder, as a professional,
Red October for all the wrong reasons.
I have to say, I was in a hotel with the Arizona team when they lost.
Yeah.
Am I wrong?
Well, they lost a few games in Philly, but they ended up winning the series.
Yeah.
Hey, we're not going to talk about it, Carol. All right?
Okay.
Yeah.
Sorry.
It's
No, I'll shut up.
It's still too painful for some of us. But Amanda,
Too soon.
Too soon. No, Amanda, I mean, we're going to talk later in the show about sort of this wild year of volatility in the bond market. And I wonder, just as a professional in these markets, what's it like coming in every day and seeing these wild moves in the Treasury market? This market we were so accustomed to being quiet and sort of boring, and what do you think is needed to calm it down?
Well, it's a great question. It's almost an unanswerable one at the moment here. I think as investors, we've been conditioned to a hashtag high volatility regime for quite some time now. I mean, think about the last 3 years of unprecedented challenges and negative returns in the bond market. So we're starting to get conditioned to this. But I think at the end of the day, it's all a function of this unprecedented policy accommodation that came in at the onset of the pandemic, and now this unprecedented unwinding. At the end of the day, it's just going to take a lot longer. I keep saying longer for longer. It's not higher for longer. It's longer for longer. Everything about this is just going to take longer to normalize than what investors would like.
And I think it's, again, kind of just hammering the same thing that I feel like Mike and I kind of agree in terms of what we got from Jay Powell, the risks of doing too little. They're worried about that, even though he's stressed right out of the gate. We've got a dual mandate, and that eventually maybe some of this will start to work its way into the labor side of the equation. The risks of doing too little is certainly, I feel like, top of mind for him.
Absolutely, and we agree with that. That's why we continue to think that the door is potentially open for some tighter policy ahead. I think the key question is whether the market has done the Fed's job for it or not, and he even acknowledged that a little bit, that with the violent
Do you think the market has done enough of the job for the Fed at this point?
I think it's done enough at the moment. I mean, think about the 100 basis points that we've seen move here in the longer term portion of the curve. It's been a very violent move, no matter how you slice and dice it. And so I think for now, we're definitely in sufficiently restrictive territory, but there's still plenty of ammo from an economic data perspective to go further here. Economic growth continues to come in pretty strong. ISM report today gave a very polar opposite story here, but U.S. consumers still very strong. Inflation not to the long-term target. So I think there is room. I think we just need to, as Powell said, let some of the lagged effects of this policy work its way through here. But we are definitely in restrictive territory for sure.
You know, Amanda, one of the themes this year is the yield curve, you know, the difference between yields on shorter-term debt and longer-term debt. And we've been living with this inverted curve for a long time where the shorter maturity debt is yielding more than the longer maturity debt. We have seen this very aggressive steepening in the last few months. And you had a really interesting point in your note to us talking about that steepening of the curve. And it's a very unique thing that's happening, this bear steepening of the curve while it's inverted. What's the takeaway from that?
Well, I think it's an interesting dynamic because we, of course, have this inverted yield curve. It's been consistently inverted for the better part of a year plus. But we're also having this bear steepening phenomenon. And usually when you see that start to come into the equation, it's like, oh, here's the signal for something's going to crack in the backdrop. But it's actually only happened once in the last 50 years where we've had both of these dynamics in play, that you don't usually see them together. And so the one time that we have in history was right before the 1969-1970 recession began. And so one data point does not make a trend. It's not a perfect guide or predictor for what's to come next, but we do think the net effect is just a lot of pressure on high valuation stocks and the long end of the curve too.
All right, we've got to run. Hey, listen, Amanda, thank you so much. So appreciate it. Amanda Agati over at PNC. Right now, over to our TV colleagues for Beyond the Bell.
Economists over at Citi helping us parse some of what we heard from Jay Powell. Our special coverage continues as we count you down to those closing bells and take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here alongside Katie Greifeld and Scarlett Fu. We're counting you down to the closing bell. And guys, we talk about sort of all the importance of what we just heard out of Jay Powell and the Fed. Obviously, no change in rates here, but I think the communication seemed to fit with what has already been the unfolding market narrative.
What people had priced in already, and they got confirmation of that, which is the rise in yields has done a lot of the Fed's work for it, maybe even all of the rest of the work for it.
But then you take a look at how fickle, of course, that narrative is. You look at 10-year yields down about 17 basis points today. Obviously, the rise so far has tightened financial conditions, but how sustainable that is a question.
All right, let's bring into the conversation our friends Carol Massar and Tim Stenovic from Bloomberg Radio as we welcome our audiences across all of our Bloomberg platforms here. And excuse me, Mike Regan filling in today for Tim Stenovic. Carol, what did you make of what we heard today?
I felt like it was a lot more of a hawkish tone. I'm just kind of writing some of the notes. You know, Jay Powell saying the key question is inflation still cooling? He's worried about the risks of doing too little. Inflation remains elevated. Amanda Agati, who we just talked to over at PNC, she says, I am discounting the trade today. She goes, the sentiment going into this Fed decision was pretty lousy at this point. So there's definitely some repositioning going on. And she says the door is definitely open for more rate hikes. The question is, and this is something we're going to have to watch over the next couple of weeks into that final Fed meeting of the year, is whether or not the market continues to do some of the Fed's work, which is something Romaine Jay Powell certainly addressed.
Yeah, obviously a big focus on what we heard out of Jay Powell and the Fed. We should point out, too, we are getting quite a few earnings coming after the bell tonight, including from Qualcomm, DoorDash, Airbnb, Zillow, PayPal, and a few others. So sit tight here. We have a lot that we have to parse here over the next hour or so. Meanwhile, we get the closing bells here in New York. The Dow Jones Industrial Average higher by about 0.8% here on the day. The S&P 500 going to close higher by about 1% here on the day, while the NASDAQ Composite higher by 1.6%, and the Russell 2000 getting in on the action. It's your relative laggard, guys, but still managing to close it out, up about 0.5%.
All right, folks, do we want to do Qualcomm? Let's go to it. Let's get to the outlook because I think that's the red sticky. First quarter adjusted EPS, $2.25 to $2.45. So, guys, they are bumping this up. The street estimate is for $2.25 a share. So, again, the outlook moving to the upside. First quarter revenue, they're looking at $9.1 billion to $9.9. That, too, the upside potential, definitely above what the street is expecting. They're looking for $9.25 billion. Again, first quarter adjusted EPS Scarlett, 225 to 245. And we're taking a look at Qualcomm in the aftermarket. It's up about 2.7%. Stock's been off about fractionally so far this year.
And keep in mind that Qualcomm shares have underperformed the rest of the semiconductor stocks so far. And we are seeing semiconductor stocks lead the gains today. We've heard really encouraging numbers out of Intel, out of AMD over this earnings period. So this just adds to that idea that the inventory overhang we've gotten in semiconductors seems to be clearing.
Yeah, and a big gain in the QQQ, the NASDAQ 100 index ETF today, up about 1.7%. We are seeing that extend in the after-hour trades as people digest this Qualcomm news, Katie. So maybe there is some fuel for this rally to continue tomorrow.
And it's interesting to sort of pull out what this means for the industry overall. Of course, you think about the mobile phone industry's inventory glut. You see these Qualcomm numbers. Maybe that's a sign that that's starting to improve. But, you take a look at the share reaction. It's not too huge here. Again, 2-3% higher. It's going to be interesting, of course, as always, to hear what the executives have to say, because obviously a big upgrade to that outlook.
Yeah, a big upgrade to that outlook. And are we going to hear something similar out of some of the other names? Obviously not the same industries here, but as you get that cross-section here and try to get a read on whether those economic conditions, like Jay Powell said, are supportive of the Fed's current stance, that question still open.
Well, remember Qualcomm, right? A great indicator in terms of what's going on in the smartphone market, which is definitely off some of its highs that we've seen, a few years ago, if you will. And so we're watching.
Are the phones still smart? I mean, if every phone is a smartphone.
Smarter phone? Smarter phone? I don't know.
We also have earnings out from Airbnb. Why don't we hit that one, because that's a red sticky if I've seen one. Fourth quarter revenue, this is a forecast here of $2.13 billion to $2.17 billion. The consensus estimate is $2.18 billion. So that looks like a bit of a miss here for Airbnb. So Airbnb coming out with a forecast that doesn't look as encouraging as maybe investors had expected. As for the third quarter, the quarter that ended, revenue was $3.4 billion, slightly higher than what analysts had anticipated, $3.37 billion. Nights and experience booked totaled about $113.2 million. Analysts are looking for $112.9. I don't know what nights and experiences booked is. That must be a new segment of their business. Gross booking value.
Well, that's actually an interesting one because
it's a small amount though.
Well, they're sort of splitting out the longer term folks from the people who actually did, I guess, what Airbnb was originally intended to be, which was for those overnight stays. But of course, we know a lot of these quote unquote work from home people seem to be permanently work from home.
Stock's been on a tear.
We don't know who those people are.
I do. Can I name a few?
In any case, you can see the shares of Airbnb bouncing around after hours, currently down about 3%. But this is also a case of this stock was up, what, 40% coming into tonight's results. So high expectations, and that's been the story for a lot of some of these companies that we're seeing that are still sitting on pretty sizable rallies year to date. That raises the stakes for the numbers, and we know this has been a punishing market.
Yeah. 8% of the float, too, is shorted, so, if there's any kind of disappointment.
Yeah. Big rally going on in Roku, too, after they reported revenue that beat estimates, and that fourth quarter adjusted EBITDA at $10 million compared to a loss estimate from analysts of $57.6 million. So big gain in Roku after those numbers remain.
Yeah, up about 11%, one of the biggest gainers that we're seeing here in after-hours trading. But we talk about this idea here of where the money is going to go and the sort of the flip-flop through, I guess, what some people think is essential and what some people think is discretionary here. And even just to go back to Airbnb, I mean, part of this is about that growth rate in revenue and bookings, which are still in the double digits. But we're talking about a year ago, those double digits were something like 50% a quarter, and now we're down into the teens in terms of percent increases.
Hey, here's a little color, too, from Airbnb. That disappointing outlook, as we know, for the fourth quarter. They cited greater volatility in the economic environment that expects will slow demand for travel after a record summer season. And this could be a part, maybe, or the beginning of that experiential engine that has really been supporting economic growth. Could we start to see that slow down a little bit?
All right, we also have numbers out of DoorDash as well. Let's go to the forecast here. It sees fourth quarter gross order value of $17 billion to $17.4 billion. Analysts were looking for $16.35 billion. So that is certainly more encouraging than what the consensus estimate is right now. In terms of the third quarter that ended, revenue of $2.16 billion, slightly higher than the consensus estimate. You could see the stock moving up more than 4% in after-hours trade.
And part of the reason why is that's actually its strongest quarter since it went public in 2020. That is record revenue and orders. It's narrowest loss as well. Markets clearly rewarding that after hours. So again, you look at the economic environment, how it's affecting Airbnb, but people obviously still ordering food and getting it delivered directly to their door.
Guilty as charged. All right, let's go to Mondelez, also out with their earnings after the close here. Third quarter net revenue, it's a beat, folks. It's $9.03 billion. The estimate on the street was $8.83 billion. Third quarter adjusted EPS, 82 cents a share. That's coming in 3 pennies better than what the street was forecasting. Adjusted operating margin, 16.7%. That too is a beat. The estimate was 16.1, and adjusted gross margin was 38.6. Also, more than a full percentage point better. The estimate on the street was 37.4%. But Mondelez, we're just seeing it move up about 0.4% in the after hour, and the stock is little change year to date.
Yeah, decent organic growth here, and the forecast also saying that that'll continue. Interesting also that the press release, at least that I can see, not making any mention of all of the craze regarding these weight-reduced GLP-1 weight loss drugs. But of course, that could change on the conference call, as I'm sure the CEO and the CFO are going to be asked specifically that question.
Yeah, Zillow up a little bit too after they reported revenue $496 million for the third quarter, above the estimate of $480.8 million. Remember, they really got hit yesterday on that real estate investigation on commissions, so a little bit of a rebound from that today. Scarlett?
Yeah, the CEO and co-founder of Zillow, Rich Barton, says despite a residential real estate industry that's down 14% from last year, Zillow, and he's patting himself on the back here, reporting positive growth, mentioning that 3% in total revenue, 34% in rentals income, and a much bigger increase, 88% in purchase mortgage origination business. So citing some strong momentum. But yeah, the ruling yesterday is certainly putting a damper on any kind of gains that Zillow is attempting to make here, which might explain the tepid 1.3% rise right now.
All right, for all of you who love Etsy, who doesn't love Etsy, their earnings are just crossing the Bloomberg terminal. Fourth quarter adjusted EBITDA margin, 26 to 27%. That's a little light, 27.8%, or could be perceived as light. This is the outlook that the company is putting out there. Fourth quarter take rate, about 20.8%. That is just above the estimate of 20.7. Call it just about in line. And go back to the third quarter, the last quarter they just reported. Third quarter EPS, 64 cents. That's 14 cents better than what the street was forecasting. And third quarter revenue, $636.3 million. The estimate was for $630.9 million. So that is a beat, but the stock, not loving the outlook maybe. What? I don't know.
That growth number is pretty bad here. I mean, you're talking about on gross merchandise only up about 1% here year over year. And even when you take total revenue, you're down back into the mid-single digits here. So maybe that is partly a reason why you're seeing the downdraft in the shares.
Yeah, and you take a look, coming into this report, this stock is down, what, 50% year to date? And it's always interesting to look at the sell side picture after that. It still has 16 buys, 14 holds, only 3 sells on Etsy after the terrible year that it's having.
Well, it had a banner year, I believe, in 2022, so it gave back a lot of those gains.
Yeah.
But now the pressure is on for Etsy to deliver over the holiday season. Is it a discretionary website, or is it more of an essential? We'll find out.
I don't know. All right, anyway, we'll watch, and it'll be interesting, too, the analyst calls and also the analyst reactions and whether or not they do any changes in terms of calls on the stocks or target changes. All right, guys, that's a wrap for our Fed Wednesday simulcast and also some earnings flow on radio, TV, YouTube, and, of course, Bloomberg Originals. We will see you again tomorrow.
I'm gonna live where the green grass grows, watching my corn pop up in rows. Every night be tucked.
All right, everybody. Our thanks to our TV colleagues breaking down the market, some earnings, and, of course, a Fed Wednesday. So interesting day, and we'll see what Thursday will bring when we have Apple earnings. And then, of course, we've got a jobs report on Friday. All right, we do want to get to a story definitely on our radar. It's something we wanted to share with all of you. It's about how in the U.S., in the reddest district in America, where old-fashioned conservatism mixes with new-fashioned economics, people are buzzing about green jobs. I mean, go figure, right? We were talking about this earlier, Mike. It just doesn't quite make complete sense.
Yeah, right. And it's interesting to see, do people get the politics behind this? Are the red states...
or it's a job.
A job. And do you even realize, that it's this Inflation Reduction Act and the other Biden administration policies that have created these jobs? So it'd be great to hear what the reporter has to say about this.
And it doesn't matter when you go to the polls, right, come next November.
Right.
All right, with more on what's going on, we turn to Bloomberg News ESG reporter Sejal Kishan on the phone in New Jersey. Sejal, great story. Take us to North Alabama. Its political foundation administration and what you found out is going on when it comes to a very, I guess what some would call is a more liberal initiative, and that is anything green.
Hi, good to, thanks, Carol, it's good to be here. So I visited Congressional District 4 in North Alabama, there's a new solar factory being built there. It's going to provide something like 700 jobs. So bearing in mind that this district, more than or just about 80% of voters voted for Trump in 2016 and 2020, and yet they're all very excited about the new economic jobs that are coming their way.
Now, Sejal, do they talk about the politics involved in this? Is there sort of an acknowledgement about the policies that helped create these jobs?
Well, I mean, it was what Carol said earlier, a job is a job. And at the end of the day, they're not really focused on the politics that maybe, the rest of us are. Over there, it's really about practicalities, and they're much more pragmatic. And so if that's going to bring economic prosperity to their region, then they're welcome, they're open arms about it.
These are, I assume, pretty good-paying jobs, I would assume. Is there, a lack of industry otherwise in this area that this is really filling a hole that was left?
Yeah, I mean, there's definitely industry in the area. It's just outside of Huntsville, where you've got the NASA Space Research Center. You have Jeff Bezos. He's got Blue Origin, his space exploration company. So there's a cluster of space exploration companies out there. But in Lawrence County, something like 10 years ago, a paper mill, which was the largest employer in the county, had shut down, and it had employed about 1,000 people, more than 1,000 people. Industry has been coming back here and there. There's a Lockheed manufacturing facility there, Jack Daniels Cooperage there, but this solar plant is going to be the biggest one.
Well, and I always think it's interesting, especially as we're coming up, or heading into a presidential election year, and we've done, polls. There's been a lot about people not feeling happy about the economy, and a lot of what they point to is higher prices that are out there, and they're talking about inflation really, eating into their pocketbook. It used to be, Sejal, that I feel like it was all about jobs. I mean, or more broadly, it's the economy, stupid, right? That was the slogan that we always heard about. And I do wonder, how important something like this might be in messaging come next November when it comes to talking about what the president did in terms of the economy, versus what the former president might have done, because he was rolling back a lot of environmental rules and regulations. Green wasn't necessarily top of mind for him.
Yeah, no, absolutely. But again, these people are not looking at this as red and blue like maybe other people in the country are. They're just seeing this as a job. And as one of the people that I interviewed there, he just said, this is not about ideology. This is really about jobs. And so, they're less focused on the politics of it all and more focused on the economics.
Sejal, just the sort of dimensions of this plant are pretty fascinating. You write that it'll span an area the size of roughly 40 football fields and create more than 700 jobs. It's set to be the county's largest employer when it opens late next year. I wonder what's the nature of these jobs that are being created? Is it the type of thing where they'll have to bring in experts and people with specialized skills, or are these 700 jobs really going to be available to sort of the local blue-collar workforce?
Yeah, no, I mean, primarily the latter, but definitely there will be people coming in from all over. And North Alabama, it's a part of the state where people are used to commuting like 50 miles, and so it has drawn residents from Tennessee, nearby Georgia, and even Mississippi. So it's going to be basically a boost for the whole region, not just the county.
Sejal, hang on for a second. I just want to mention some headlines. A Goldman insider trader getting 36 months in the Squash Buddies case. You might remember this was a former Barclays trader who said he got an insider tip from an ex-Goldman Sachs group vice president at a squash court after having too many drinks. Well, nonetheless, the Goldman trader getting 36 months in that case, insider trading. And I do also want to mention a headline involving PayPal that just crossed. It looks like they are getting a new CFO. They have a new CEO, but it looks like, I'm just looking for the headline, that they are also getting a new CFO as well, Jamie Miller. So there's a bunch of headlines coming across the tape in connection with earnings, but also a few other stories. Hey, Sejal, just got about a minute left here. As you reported out this story, what do you think? I always like to ask this question. I think about the Bloomberg audience who are listening and watching right now, what they kind of need to understand about this story that you did, because it's not something that's front of mind, top of mind, but this is what we kind of do really well at Bloomberg, is bringing out a story that really should be probably on everybody's radar.
Yeah, well, I mean, the topic is highly nuanced. Why it's as, maybe some of us here in New York might like to think it is. Some of the takeaways that I took away was that, people there were very thoughtful and very pragmatic about green energy, and while they welcome it, they're talking about some of the limitations of green energy. For instance, what do you do with lithium batteries? Do they end up in landfills, for instance, or EV tractors? The batteries are probably too heavy for the type of soil that they have. So while they're welcoming green energy, they're much more thoughtful about the implications of it.
All right, we're going to leave it on that note. Listen, thank you so much. We highly recommend folks check it out on the Bloomberg, and also head to Bloomberg.com for more on this story. Bloomberg News ESG reporter Sejal Kishan on the phone in New Jersey. And we've got some other earnings. Clorox trimming its outlook for the fiscal year, and that stock, we've definitely seen it move in the aftermarket. It is right now, actually it's little change, but it had taken a big dip earlier on. And we'll also bring you some more earnings on the other side. You are listening and watching Bloomberg Business Week. Carol Masser along with Mike Regan. He is in for Tim Stenovic on this Fed Wednesday, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 4:21 on Wall Street. We check the markets for you all day long here at Bloomberg. Big day. Qualcomm shares right now, though, in the after-hours session, they are up more than 5%. This is the largest seller of smartphone chips. It's giving a better-than-expected revenue forecast for the current quarter. Fed Chair Jay Powell, did he have his dove costume on or his hawk beak? Well, investors seem to be betting on the dove, stock surging after Powell said this.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks we face, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks.
And here's how investors responded. The Dow up 0.7% on the day, 221 points higher. S&P 500 up more than 1%, better by 44 points. The Nasdaq also up more than 1%, up 210 points. The yield on the 10-year, 4.76%. Spot gold down on the day by about 0.3%. Crude oil was higher, but it finished the U.S. session lower by about 0.1%. Airbnb shares down about 2% in the after hours. It sees fourth quarter revenue lower than analyst estimates. DoorDash, though, as we've been talking about, surging as much as 10% after posting the largest total customer orders ever and raising its outlook for the year. A lot of couch potatoes there, guys. And that is your Bloomberg Business Flash.
All right, Denise, thank you so much. Denise Pellegrini in for Charlie Pellet. Well, shares of AGCO, check it out, everybody. They're up for a third day. They're up more than 6% in that time. Company reported earnings yesterday morning, of which third quarter adjusted EPS was a big beat. Third quarter net sales in line with expectations. And the maker of tractors and combines also said it still sees fiscal year net sales of about $14.7 billion, slightly above street estimates, with fiscal year adjusted EPS of about $15.75 a share. That's 50 cents above the company's earlier forecast. Three analysts, nonetheless, cutting their price targets on the company by an average of 3.5% since it reported yesterday. So let's get to it. We have a great guest. We have the CEO, Chairman, President, and CEO at AGCO. Here's Eric Hansotia. Eric Hansotia. He's on Zoom from Duluth, Georgia, and he joins us. Forgive me. I'm trying to race to get to you, so I apologize. Eric, really
good, no problem.
Really great to have you here with us. First of all, how are you? And I do have to ask you about the Fed. In an environment where the Fed says, we could still continue raising rates, we're still worried about inflation. Does that kind of mesh with the outlook that you see?
Well, your first question was, how am I doing? Great. Just couldn't be happier with the progress that our company is having relative to our strategy. We're going to have $2 billion more in sales this year. We're going to grow margins significantly. Relative to and it's all in line with our high-tech focus on being the industry leader in smart farming machines. Relative to the Fed, interest rates do weigh on farmers' minds. These are big, as they carry a lot of technology, they're expensive machines, many times $500,000 to $1 million. And so they often finance those machines, and higher interest rates are part of the decision. I'm expecting that we're at a high plateau, and that we're more likely over the coming year to have rates go down than up, and that would be welcomed by our customers.
Eric, I'm looking at the revenue growth of AGCO over the years, and really some impressive growth there. 2021, it was up 22%, 2022 up 14%, 16% this year. It does, at least according to analyst estimates, look like you might be in for a dip in revenue last year. And I'm wondering what's driving that? Is that entirely an interest rate story, or is there something else going on?
It's actually very little related to interest rates. Agriculture often is not connected, not correlated highly with the regular GDP growth. It's more tied to the agricultural economy. So the price of corn, wheat, soybeans, and that's a function of how much grain there is in the world. For the last 2 or 3 years, there's been grain shortages, and so grain prices have been high. That means more profit for our farmers. Now they've had a great year this year in terms of harvest, and so there's a little bit more stock. Prices have come down a bit, and that's really more what drives farmer profitability and in turn their interest to purchase equipment.
Hey, Eric, what I wonder is longer term, how you guys think about the business, how you plan, because I wonder if things like weather, climate change, demographics globally, is that more significant in terms of how you think about the growth longer term? And if so, what does that maybe indicate to you?
Yeah, that's a great point, Carol. So we see 3 macro tailwinds plus this weather factor. So let me touch on those real quickly. Number 1, we're moving from 8 billion people to 10 billion people between now and 2050. Number 2, emerging economies are adding more meat to their diet. As they do that, that's a multiplier on the demand for grain. Chicken is a 2-to-1 multiplier, beef is a 10-to-1 multiplier. And then third is renewable fuels. So ethanol in the United States, but now the next one is renewable diesel. Ethanol consumes 40% of the corn crop today. Renewable diesel is likely going to grow to that same kind of proportion over the next few years. Those are all macro tailwinds that cause the farmer to have higher yields, more pressure on higher yields. And then weather is another one. We're having more severe droughts and more severe floods every year. That reduces the overall global ability to produce grain. So you add those 4 factors together, and the farmers are pushed to have higher yields while using less inputs, less fertilizer, pesticide, chemicals, and things like that. And so there's a big squeeze for productivity using our technology. We're using artificial intelligence on our sprayers now to be able to use vision systems to identify the difference between a weed and a plant as the machine's going through the field, and spray only the weed, saving like 70% of the chemical. And a lot of automation of features throughout all of our products.
Eric, you say AI. I'm assuming you've been using AI for a long time, though, right?
Yes, we have.
Okay.
Across many of our machines, we use AI to understand the variation in soil or crop and have the machine learn over time to be able to optimize itself real time in the field.
It's amazing because when you think of AI, the last thing I think most people think of is farm labor.
Don't you think of machines, though? I think of machines.
Well, Eric made a great point, and I wanted to ask him about this. Is right at the beginning, you said that technology aspect of your business is so important. And again, if you're not really familiar with AGCO, you might not think about that. But one thing I wanted to ask you about, Eric, and full disclosure, I'm not an expert on tractors. In fact, I hire a kid to cut my own grass, so I'm really...
Sure. I've driven a tractor, so a big one.
There we go.
So I'm coming at this from a pure ignorance state of mind, but I would think that self-driving technology would be easier to implement on the farm with a tractor. But from my understanding is it's not really. I wonder if you could talk to us a little about where you are with that type of technology. You know, will we see it anytime soon, or is it just, for whatever reason, too complicated to have self-driving tractors?
No, it's a great topic. It's at the heart of our strategy is putting technology on machines to have the machine be smarter and be able to do more things for the customer. I talked about the sprayer. We're automating all our functions on all of our machines. We've increased our engineering spend by 60% over the last 3 or 4 years since we started the strategy. We've bought 6 tech companies. We just announced the biggest ag tech deal